Good morning, ladies and gentlemen, and a warm welcome to the Ethical Finance ASEAN 2024 Virtual Summit, which we are delighted to host for the third year with our partner, the Global Ethical Finance Initiative. So thank you for joining us today. Building on the insightful conversations held over the years, this year's Ethical Finance ASEAN themed Scaling Up Sustainable Finance will continue to highlight the importance of accelerating positive climate action, considering the region's susceptibility to the impacts of climate change. The 31st ASEAN Socio-Cultural Community Council meeting held in March highlighted ASEAN's unwavering commitment to promoting social development and environmental protection, declaring climate change and green growth as the key areas of focus in ASEAN's policy agenda for the future, in line with its strategic plans to implement the ASEAN Community Vision 2045. AICB, too, remains committed to supporting our national and the region's just transition objective. By virtue of its importance in societal and economic development, I truly believe that the banking and financial services industry plays a key role in driving climate leadership. And so, through our various professional banking qualifications, as well as our thought leadership initiatives, such as the Ethical Finance ASEAN Summit, we aim to build capacity for the financial sector workforce in Malaysia and the region so that the respective climate goals can be met. I am delighted to share today we have an assembly of subject matter experts from the ASEAN region and beyond, who will draw upon their experience, their vast experience and knowledge of sustainable and responsible finance. The insightful discussions will explore the key outcomes from COP28 and expectations for COP29 and focus on climate action imperatives pertinent to the ASEAN region today, including financing the energy transition, greening finance, and developing SME resilience, nature finance, and efforts to move the Islamic finance industry from Halal to Tayyib. I trust that you will find these sessions most illuminating and be fruitful and further inspire you to guide your organizations along the sure path to building climate resilience and nurturing a greener economy. With this, ladies and gentlemen, thank you again for joining us. Please welcome Mr. Omar Sheikh, Managing Director of the Global Ethical Finance Initiative, to deliver his opening remarks. Thank you.
Thank you, Tan Sri Azman Hashim. It is a pleasure to have you all with us today. On behalf of the Global Ethical Finance Initiative, or GEFI for short, I would like to welcome and thank all the participants, partners, speakers and stakeholders joining us from across the ASEAN region and beyond for this year's Ethical Finance ASEAN 2024. A huge thanks, as always, to our partners, AICB. Thank you, Shireen, Fel, for all your hard work, connecting us with the great speakers and bringing together this excellent agenda and conversation. It's also great this year to have UNEP-FI supporting the summit. This is our third year of our summit, and the theme this year is Scaling Up Sustainable Finance, intentionally picked to underscore the critical role the financial sector must play in driving a sustainable future for the region and the world at large. In an era marked by unprecedented global challenges, the imperative for sustainable finance has never been more pronounced. Our summit today serves as an important platform to foster dialogue, innovation, and collaboration, and to amplify the impact of ethical and sustainable finance in Southeast Asia. According to the most recent edition of the Asia Bond Monitor, outstanding sustainable bonds in these economies reached nearly $800 billion at the end of 2023, making up roughly 20% of global sustainable bonds. We want to be able to scale this up to at least 30% by the end of 2035, and we believe it can only be achieved through the efforts of all of you present here today. As we gather at this pivotal juncture in human history, the challenges posed by climate change, environmental degradation, and social inequalities demand a fundamental shift in our approach to finance and investment. It is no longer enough to pursue short-term gains at the expense of long-term sustainability. We must re-envision the very purpose of finance, aligning it with the principles of ethical stewardship and responsible growth. Profit and purpose must be brought together. Accordingly, we are absolutely honored today to have an excellent lineup of speakers who will navigate these challenges, together with thought leaders from across the ASEAN region and across the globe, who bring a wealth of expertise and insights. Their contributions will undoubtedly enrich the discussions, but most importantly for us and for yourselves, we hope that they will inspire actionable strategies to advance the frontiers of sustainable and ethical finance in the region. Additionally, our GEFI Global Steering Committee Chair, Dame Susan Rice, and I are also looking forward to joining you in KL later towards the end of this month for the Global Forum on Islamic Economics and Finance, organized by Bank Negara, Malaysia. On a final note, I wish to thank all of our partners and sponsors, Accuracy, Carbon Tracker, DDCAP Group, Hermes, ING Mercers, MSCI, NatWest Group, Planet Tracker, PwC, UKLC, and of course, UNEP-FI. Without all of your support, this would not have been possible. So a huge thank you once again to all of you, AICB and the GEFI teams for bringing this together, and wish you fruitful and insightful proceedings. Thank you.
Thank you very much, Tan Sri Azman Hashim and Omar Sheikh, for your welcome remarks. My name is Shireen Kandaya, and I am the Director of Sustainability, Marketing and Communications at the Asian Institute of Chartered Bankers, AICB. I'm delighted to be the Master of Ceremonies for Ethical Finance ASEAN 2024, and we have a packed and exciting agenda today. And to join the debate online, please use the X handles, formerly known as Twitter, at Finance for Change and the hashtag EFASEAN24. To set the context for the summit, I'm delighted to welcome Arius Poon, Director, Head of Asia Pacific Insights and Analysis, S&P Global Market Intelligence, who will be presenting on the ASEAN Economic Outlook.
Thank you for the introduction, Shireen. Good day, everyone. Today, I'm going to share two key messages about Asia Pacific Economic Outlook. First, while a pickup in global growth momentum is vulnerable to geopolitical risks, Asia-Pacific will remain the biggest growth engine for the world. The second message is disinflation has become more uneven in recent months, leading the market to pare back expectations of the timing and the magnitude of rate cuts. So let's get started. The risk of regional war in the Middle East has increased, following an Iranian attack against Israel and a subsequent response from the Israeli military. Our base case remains that a full-scale regional conflict will be averted, in part due to diplomatic efforts to limit any retaliatory responses, aligning with the muted initial reaction of commodity and financial markets to the news. Still, uncertainty over the outlook has increased and is likely to persist. In an escalation scenario where the economic impacts would likely be felt through various transmission channels, including higher crude oil prices, a resumption of inflationary pressures, and related constraints on monetary policy easing. The adverse effects on growth prospects would be most acute in the advanced economies, which are typically net energy importers. Having said that, globally, a broader-based pickup in economic activity continues to be signaled by various purchasing managers' indices. Business activity in both manufacturing and service sector is improving, albeit modestly. Business activity growth in emerging economies also continues to outperform advanced economies. S&P Global Market Intelligence has upgraded our annual global real GDP forecast for 2024 from 2.6% to 2.7%. However, underneath the global numbers, there is substantial variation among different economies. For instance, US economic performance has been exceeding market forecast, while in Asia Pacific, growth is also uneven. India and Indonesia will likely lead the region as some of the fastest growing engines, while mainland China is facing multiple headwinds. Over the next decade, Asia Pacific, which is the red color in the pie chart, will contribute 55% of the world's real GDP growth, in which more than half of the region's growth is from mainland China. And we have already taken into account the unsteady recovery we've seen since the pandemic reopening. Meanwhile, India and ASEAN are the region's rising growth engines. A gradual recovery in electronics exports, combined with a continued rebound in international tourism, will support the export sectors of many APEC economies. These will filter through wages and wealth and bolster household consumption. In mainland China, the better-than-expected recovery in the first quarter of 2024, driven by manufacturing strength and a rebound in service consumption, has laid a strong foundation for the economy to reach its 5% annual GDP growth forecast this year. Although sequential moderation is expected in the second quarter, given sustained demand weakness. Policy tools would include reserve requirement rate cuts, interest rate cut, as well as local government special purpose bond and tax reduction, among other things. The latest 1 trillion yuan sovereign bond issue, which is around 1% of China's nominal GDP, leads us to expect more proactive fiscal policy is on the horizon. This issue will likely boost economic growth in the next few years. Our first message focuses on how economies are growing at different speed while facing geopolitical risks. What does that tell us about the inflationary outlook, which is a key factor for central banks in deciding when and by how much they are going to cut policy rates? That brings us to the second key message today. Disinflation has become more uneven in recent months, leading the market to pare back expectations of the timing and the magnitude of rate cuts. Our forecast for global CPI in 2024 is 4.8%, down from 5.7% in 2023. A further moderation to 3.3% is forecast in 2025. CPI in APEC, excluding mainland China and Japan, is forecast to fall to 4% in 2024, from 5.4% in 2023. Core inflation is on a downward trend in most of the major economies in Asia Pacific. However, food prices remain volatile, posing a risk to a disinflation trajectory. Globally speaking, further declines in CPI rates are generally forecast as supply and demand continue to rebalance. But sticky services inflation rates are contributing to a slower pace of disinflation. It is mainly because service inflation is more labor cost driven, typically more sensitive to domestic economic conditions. On the other hand, core goods inflation, which is sensitive to global factors such as commodity price swings and supply-side bottlenecks, has been coming down more quickly. Crude oil prices had not been significantly impacted by the latest development in the Middle East. The price of Dated Brent crude has remained relatively stable within its recent range, close to $90 per barrel, despite the heightened risk of wider regional escalation. Excess global supply is expected to continue to dampen prices, but an escalation of the conflict is a key upside risk. Our assumption of limited inflationary effects from shipping disruptions is supported by recent data that showed a general shortening of suppliers' delivery times. So, how will a less certain inflation outlook shape the monetary policy pivot? For the US Federal Reserve, for now, fewer than 50 basis points of cut are expected by the end of this year, which is compared to a peak of over 160 basis points expected during late 2023. Disappointing inflation data have increased the likelihood of easing only from the second half of the year. The shift in US rate expectations has continued to put upward pressure on Treasury yields, providing near-term support for the dollar. In Asia Pacific, while we still maintain that most central banks in the region will be either cutting rates or maintaining rates given the moderating trends in inflation, the depreciating local currencies are pressuring central banks to act and stem the decline. One recent example is Indonesia, where the central bank unexpectedly raised its benchmark 7-day reverse repo rate by 25 basis points to support a tumbling rupiah. Another example is Japan. As the Japanese yen continues depreciating against the dollar, the central bank is also under increasing pressure to raise the policy rate again earlier than planned. In conclusion, we are in a world where change is constant, disruptions are normal. I hope you will find the message today helpful. Thanks a lot for listening.
Thank you very much, Arias, for that interesting presentation. That was a great economic outlook, and I welcomed your comment that Asia Pacific will remain the biggest growth engine for the world. From here, it is my pleasure to introduce our opening keynote address from Muhammad Rashdan Muhammad Yusuf, Chairman of the Energy Commission Malaysia. Rashdan has over 32 years of corporate experience in the corporate finance, investment, and financial services industry. Prior to joining the Energy Commission, Rashdan held several roles at Gamuda Berhad, Khazanah National, and Maybank Investment Bank Berhad. Over to you, Rashdan, to deliver the opening keynote for this year's summit, talking about how we can scale up sustainable finance in the ASEAN region.
Thank you, Shireen, for that introduction, and a very good morning to all the distinguished delegates of this conference, Scaling Sustainable Finance in ASEAN. Firstly, I'd like to give a very warm thank you to the Global Ethical Finance Initiative, or GEFI, as well as the ASEAN or Asian Institute of Chartered Bankers, AICB, for inviting myself today to address all of you with some brief words regarding the topic at hand, scaling sustainable finance in ASEAN. Let me start off with Malaysia, my beloved home country, of course. Malaysia has taken some firm strides of late to really advance sustainable finance. In late 2022, our Securities Commission had issued a principles-based sustainable finance and responsible investment taxonomy for all capital market participants. It is about 45 pages long, outlining in some detail the environmental, the social, and sustainable components for sustainable financing. Then in late 2023 and also in early 2024, the Joint Committee on Climate Change, or JC3 as we call it here, and JC3 is essentially a joint collaborative committee between all key financial regulators, as well as banks, insurance companies, financial institutions in Malaysia. And JC3 had launched more initiatives and priorities to support a just and orderly transition of the economy, and of course, with sustainable financing right there front and center to do just that. In a recent speech, the governor of Bank Negara, our central bank, expects half of all new bank financing by 2026 to be aligned with our green and with our green climate policies. And on that note of policies, Malaysia has launched an ambitious energy transition roadmap, or as we call it here, NETR, to be net zero by 2050, and we do so by substantially increasing our renewable energy mix from 40% to 70% by the same date, 2050. Now, that increase from 40 to 70% entails an 11-fold increase in renewable energy capacity. And included in that policy roadmap as well is the reversal of a renewable energy export ban that Malaysia once had to all our ASEAN neighbors. But now instead, we are actively embracing and pursuing a policy of renewable energy exports to our neighbors. In that regard, I'm happy to report to all of you that Malaysia has just launched a renewable energy exchange mechanism, or ENERGEM in short, or that's the acronym, to enable renewable energy exports to Singapore. These new progressive policies would certainly accelerate sustainable finance projects, not only in Malaysia, but also across our ASEAN neighbors, as it takes all these parties as we embrace an approach of prosper thy neighbor. And as the saying goes, when you prosper thy neighbor, you prosper thyself. You have heard quite a number of key positive developments in both financial and sustainable policies, but also in energy transition policies. But what are still the key and major challenges ahead for sustainable finance in ASEAN? One of such challenges, in my humble opinion, not only in Malaysia, but also across ASEAN, is basically the need for inclusive and affordable energy or electricity for the citizens of ASEAN. For Malaysia and quite a few of ASEAN neighbors, to do just that would mean to rely on cheap fuel resources. And to achieve that goal, Malaysia at least has relied quite heavily on coal. Indonesia is in a very similar position, as Indonesia itself is a coal producer. For Malaysia, our predominant fuel mix is coal at about 58%, followed by natural gas at 35%. So our current energy mix is over 93% fossil fuel base. Now, that in turn would mean that there's tremendous Scope 2 and Scope 3 emissions across the nation that's just very, very hard to avoid, but that would encompass almost every economic activity within Malaysia, and the same position is for some of our ASEAN countries. There is also the political challenge, of course, and that is that vast populations of ASEAN countries, who are, of course, some are quite impoverished relative to other more advanced nations, our populations basically are not happy with the possible increases or substantial increases in energy tariff brought about by the ESG demands of the what I call the RE100 group. The RE100 group are a set of highly capitalized, sometimes trillion-dollar market caps, multinational global companies with ambitions of energy-intensive data centers that they want to set up here within ASEAN, and they all want it to be green. But the infrastructure required to enable this is basically now going to be in the trillions across ASEAN. And because of these demands, who pays for it? And that is a major political challenge as well that we all need to face to address the energy transition economy. Now, how do we go about, at least trying to resolve these issues? So, first and foremost, I believe that Malaysia and other ASEAN economies truly need to embrace the market pricing of energy. And such market pricing would thus avoid the basically issue of subsidizing energy or subsidizing brown energy relative to green energy. That in itself makes renewable energy relatively expensive to brown energy, and therefore really makes sustainable financing very, very difficult indeed in these countries when there is a much more cheaper or economic solution. It actually renders such green or renewable project financing to be uneconomic. So what we really need to do is to wean off from such subsidies and embrace market mechanism in our energy supply markets. And we need to do this across ASEAN. And then what about the affordability issue? Well, the affordability issue can be addressed by perhaps direct subsidy mechanisms to the less fortunate, but certainly we should not go back to price subsidy mechanisms which are highly distortive. And so I'll also like to address another area, which is the issue of carbon pricing. So it's not just about the price of energy, but we should also need to price carbon appropriately. And if and once we do that, then truly sustainable finance can take off because the underlying projects themselves become truly viable. And in this regard, I'd like to just give a shout out to my Singaporean counterparts who have very recently, in the last month of April, taken the bold and very brave step of increasing their carbon tax from 5 Sing dollars right up to now 45 Sing dollars, which is a 9-fold increase. And I understand that they intend to further increase it to a range between 60 to 80 Sing dollars in the near future as well. So such incentives on carbon pricing would obviously have a disincentive on fossil fuel-based generation and instead truly accelerate energy transition or renewable energy acceleration in those countries that have carbon tax. And I sincerely hope that the rest of us in ASEAN would follow suit. I do believe this is necessary anyway, as the rest of the international markets also adopt such practices. For example, in Europe, they have the CBAM initiative, which would come in force soon, and a lot of the exports from ASEAN would be subjected to such carbon-based adjustment mechanisms. So to conclude, I believe ASEAN must embrace the reality of true energy market pricing, and not just energy market pricing, but also carbon pricing. And once we do, we take these bold steps to realign our economy with the right incentives, then these projects of sustainability and renewable energy projects will become viable, and sustainable finance itself would be quite, would be naturally be the right financing tool for these projects. I believe that we really don't have a choice as the rest of the world advances on these fronts anyway. And whilst subsidies are a very natural short-term solution, subsidies themselves are clearly not sustainable. So I hope, especially with some members of ASEAN who has already taken the step, such as Singapore, I'm sure the rest of our ASEAN nations, as we take the approach of renewable energy exports and we'll be building out infrastructure to help one another, we would also align our policies accordingly towards market-based pricing and carbon pricing. And in that regard, sustainable finance will flourish. With that, I thank you all, and I wish you a very good conference ahead. Thank you very much.
Thank you, Rashdan. Whilst there are clearly challenges in scaling up sustainable finance in the region, it was great to get your thoughts on how we overcome them to ensure finance better serves people and the planet. Next up, we have Christopher De Vere Walker, Head of Power and Utilities Carbon Tracker Initiative. Christopher will share some data and analysis on the extent to which the power sectors in Indonesia and Vietnam align with the goals of the Paris Agreement, highlighting the risks and opportunities associated with the transition.
Thank you, Shireen, for the introduction. So an introduction to the our country profiles, carbon trackers, power and utilities. We model 9,000 generation units, 20 million data points, and the model output is OPEX revenue breakdowns, project finance time series, demand constrained phase out, the LCOE and NPV, IRR, and stranded asset risk for new units. And of course, the renewables levelized cost of electricity. So it's a very comprehensive model. And as an output, we produce country phase outs, and this explores the timeline and strategies for phasing out high emission energy sources within each country. Also, another output of this work is the profitability over time. This is an important piece of analysis for the financial sustainability of energy sources and trends over time. And another output again is the renewables versus fossil fuels. This is to compare the growth and impact of renewable energy sources against fossil fuels on a national scale. So We also have a data portal, which I would like to draw everyone's attention to, where you can see all of this data freely. It's free to look at, free to navigate around, and it's very interactive. And moreover, you can download the data to use for your own purposes. I want to come to the spotlight on Indonesia and Vietnam, and we want to look at the power mix, the transition plans, economic growth, and decarbonization dilemma that these countries have. They're two particularly interesting countries because they are both countries share, a lot of the sort of similarities where they've got high demand growth, between 6 and 10% a year. So they've got to continually fill the gap that they have in terms of the production gap. Indonesia, in particular, 61% of Indonesia's installed capacity is coal, and since 2010, Indonesia has been power production through coal has been growing around 10-11% a year. So it's very, very intensive. It's continually drawing on those coal assets. If you look more closely in the last, more recently, and since 2015, the situation hasn't changed that much either. It's around 8% per year. So the country as an overall leans very heavily on its coal assets, and this is going to be very mindful for the policymakers. The coal fleet for Indonesia, again, has a similarity to Vietnam, and insofar as that the coal fleet averages around 10 years old. And so these assets will be certainly be in the system for a very long time if there isn't a concerted effort to find a financial mechanism to take these assets out of play. So they're very young. As a comparison, Vietnam, 45% of its generation mix is coal, another very high percentage. Where it is slightly different to Indonesia, its coal power production per year is growing around 20%, anywhere between 19 and 20% per year. And so that is even more so than Indonesia, and that shows how much the country leans on its coal. And again, as I mentioned earlier, similar to Indonesia, Vietnam's coal-fired fleet is pretty young, averaging around 10 years. So where Indonesia and Vietnam are very much the same is that they have a heavy dependence on the coal-fired fleet, and they also have a huge demand on the coal. When you look at their renewables, renewables is growing quite quickly, like in many countries in Indonesia, but it's certainly not filling the gap. So for instance, since 2010, wind power production has been growing 60% per year. And if you look much more closely for Indonesia, wind power production has been growing even faster than that, 160%. So it's really rampant in that sense. Indonesia's solar power production is growing very fast as well. It's growing around 70% a year since 2010, and solar has been growing even faster since 2015, on average around 107%. What is this all telling us? Yes, coal is growing really, really quickly, and that's still a heavy dependence for Indonesia. And whilst it's adding quite a lot of renewables, it's just not keeping up with the demand, because the demand in Indonesia is drawing on the system. Vietnam, same sort of story. Wind generation since 2010 has been growing around 50% per year. Since 2015, the statistics are looking around 93%. So again, it's the same story. Whilst it's coal, whilst it's renewables are growing quite rapidly in terms of power production, the coal is filling that gap and it's growing even faster. So how do we deal with this problem? How do we find, why are we in this situation where coal is growing so fast? Well, they just simply need the power. It's that simple. They also need the inertia. What does this mean? This is the stability in the system. The system operator needs stability. And while they grow their renewables, they still need a huge amount of that predictable power that is very much in demand for keeping the system stable, and also it depends where that demand is needed, particularly in industry. We in Carbon Tracker have got some enabling thoughts, if I could put it like that, for the enablers of the energy transition. We are developing a least cost financial retirement mechanism, which builds on very much on our core models that I mentioned earlier. The two main use cases is the macro level and the micro level and the macro level, as per my slide. And what this ultimately, this model does is it looks for viable mechanisms that both free up the invested capital and retire coal-fired plants early, particularly young coal-fired power plants. So it's very much geared for markets like this. The key thing here is to ensure that the initial investors and refinancers achieve their expected rates of return, and that is absolutely critical here. And so we're identifying this by unit, and that's pretty important. But what has to go along with our model? What has to go along with the success for enablers for energy transition? Well, the policymakers have to continually to be aligned. The rules and regulations have to continually to be updated in order to favor less coal and favor more renewables, and also favor grid infrastructure. Grid infrastructure is going to be the critical component to get right in order to enable a smoother energy transition. But one area I've not spoken about is market design, and it's market design needs to keep up with the energy transition. It needs to keep adapting, yet keep offering predictability to investors. And that is a very important factor. So if we were to look at it as one large picture, I would say that you need to induce an energy transition in essentially 4 key ways. You need to give the predictability and have a solid study and understanding around the technical economic features of any particular market. And in this case, it's the in this case with the market of Vietnam and Indonesia, you need to be very aware what are the economic drivers of this economy. You need to understand the social implications. What is a just transition for these two economies? What is going to be detrimental from a social perspective if you get the balance of the energy transition wrong? The policy, rules, and regulatory market design. This is forever an evolving situation, and there's a lot to learn from Western markets where they've got it right and where they've got it wrong. What I principally say about markets like Indonesia and Vietnam, they don't want people like us just pointing at a problem. They want us to bring them solutions that actually work. And this is where I go back to our least cost financial retirement mechanism, because we're looking for the mechanisms that will bring a transition about in a practical sense. And that is basically the goal that we are going for at the moment. I want to hand back to Shireen, and thank you very much indeed for giving me the platform to address these two markets.
Thanks very much, Christopher, for sharing mechanisms that will bring practical solutions to the region. The Financing the Energy Transition panel will now consider the progress made to unlock investment and mobilize the funding required to successfully transition to cleaner and more sustainable energy sources. The panel will be moderated by Dame Susan Rice and feature speakers from AmBank Group, Bursa Malaysia Berhad, ING, and Mercer. Dame Susan Rice has a distinguished background in finance and banking. She was the first woman to head a European clearing bank and was a non-executive director of the Bank of England. Recently, Dame Susan was appointed independent chair of 4th Green Freeport to deliver a green growth strategy for Scotland's industrial corridor. Over to you, Dame Susan and panelists.
Good morning and welcome to the first panel of the day. And Shireen, thank you very much. We've called this panel Financing the Energy Transition. Now, those are simple words to describe a not so simple challenge. How do we get enough finance today as well as tomorrow right across a market that's both complicated and new? With the energy transition, there's an urgent imperative to provide finance for new types of assets and new activities where we don't have the benefit of history to help us understand and monetize the risk that's involved. But of course, at its heart, finance is about taking and mitigating risk. With the energy transition, however, we have to do it in uncharted waters. And it needs to cover everything, the global north and the global south, which start from very different points, cities and rural areas with very different needs, systems such as energy, food, transport, shelter, with very different requirements. It's just not straightforward. I often find myself saying that the sector has to be a pioneer while still operating within regulatory and fiduciary constraints and mindful of the economic impact of what it does. So a challenge, yes, but an exciting one. Our panel will put a spotlight on some of the ways finance is being mobilized for the energy transition today, with tomorrow firmly in its sights. Now, we have a really interesting panel. I know that because one of my panelists is an ultra marathoner and triathlete. Another is a graduate of Strathclyde, one of the universities here in Scotland, though not from Scotland. Another panelist is a sometime organic farmer, and another has lived off-grid for over 10 years. So I admire them all for those reasons, but I'm not going to tell you who's who in relation to these activities, intriguing as they are, because I want to introduce them in relation to their professional focus. To kick off the panel, I'll ask each in turn to draw on their own experience in the ASEAN countries in financing the energy transition. I'll then open things up for more general discussion and we'll see where that goes. So let me start with the introductions and start actually with Helge Beerten. Now, Mercer is a firm that we at Jeffy have worked with. We know some of your colleagues. Helge is partner at Mercer, and even more so, she is Mercer's global chair on sustainable investment. And she has broad influence as an advisor and writer working with some of the most notable multilateral institutions. So first question to you, Helge. Within Mercer, what are you seeing in the ASEAN region in terms of investor actions to mitigate risks and seize opportunities that are associated with the energy transition?
Thank you, Susan. Well, we see investors increasingly investing into renewable energy because we know that production costs are falling, and that's so important. We see investment into, for example, in the ASEAN region, hydropower, utility scale, solar PV and onshore wind. But obviously there also needs to be investable transmission and generation that supports it. But there's some terrific examples in, for example, Malaysia and Vietnam. So falling renewable energy production costs are supporting investor action. But as we know, we also need robust government policy, regulation, and transparent disclosure and corporate reporting. Another element that we see investor action in is blended finance, and this is becoming an evolving area of investor action, with some ASEAN pensions and large managers taking For example, 20% first loss risk reduction, and they look to funding from philanthropic and catalytic sovereign capital. There are lots of different types of investor vehicles and tools, such as green bonds. I know we might talk about them later, sustainability-linked loans, and investment products that consider, for example, nature impacts, green waste to energy, wastewater solutions that improve water quality. And we're seeing an increased interest, particularly in global investors, in supporting a circular economy. So looking for companies in the region that help transform carbon into materials, and also looking at biodegradability. I just wanted to add that in a recent Mercer study we prepared called Transition Today, we noted the capacity for investment, and this is the sort of frustrating but exciting, as you say, element to investor action. In this study, we looked at the finance flows into climate investing, and that private sector capital, which represents the largest pool of capital within the private sector, is 0.01% of their asset base. So a lot more can be done. The money is there. And in some quarters, there's a call for asset owners to weigh in more, for public money, pension assets to be core to funding. But key to this is, as your question suggests, is risk reduction. So the ASEAN region needs to offer investors a like level to OECD countries to attract those large institutional investors. And that's a bit of an ideal. So just to sort of sum up, I guess like many other regions, the ASEAN region runs the risk, if we want to talk about risk, of underinvestment across almost all energy technologies, according to the research.
So that is very interesting, and you're saying, in talking about activities and areas of focus that are developing, and we see them, in areas and regions around the world. But a very interesting point that you finished up on, saying that the region right now possibly is facing underinvestment. What do you think it needs to happen quickly to change that perception? You're talking about inward investment. You're talking about investment from financial companies within the region itself.
Yes, inward investment, and I'm sure there are others on the call that can talk further to this. I think that is critical because we do see foreign capital coming in, as I was saying earlier too, with those examples in Malaysia and Vietnam. But we do need that inward investment, that governance, that policy, and the confidence. And the application, not just to produce, for example, solar PV for export, but for application domestically.
Right. Okay, that's very helpful. Helga, thank you very much. I'm now going to move on, and Amana, I'll turn to you with a question. Amana Abubakar is the Chief Sustainability Officer at AmBank, and most of us will know that AmBank is one of the largest banking groups in Malaysia, and she's also a chartered accountant and a chartered banker. I know a lot of people who are chartered accountants and others who are chartered bankers. I don't know many who can claim both distinctions, so well done to you, Amana. Here's my question for you. The National Energy Transition Roadmap was launched in Malaysia last year, I believe, to accelerate the country's energy transition. So can you tell us something about how AmBank Group strategically is aligning with the roadmap, which of course points the way towards reaching net zero emissions by 2050? What's happening in the bank?
Good morning, Dame Susan Rice, my colleagues on this panel, and all participants joining us this morning. Thank you, GEFI, AICB, and UNEP-FI for inviting and allowing me to be part of this very important discussion on enhancing energy security in the region. When we looked at Malaysia's the National Energy Transition Roadmap, or NETR in short, we were very encouraged at AmBank. Now, 67% of Malaysia's GHG emission profile comes from energy. And the NETR actually provides a clear trajectory to steer the energy systems away from conventional fossil fuel-based sources and towards cleaner, more sustainable alternatives. The plan, just to give a quick background for our participants, outlines a gradual increase in renewable energy share, targeting 40% by 2030 in Malaysia and 70% by 2050. So we're using 6 energy transition levers, namely RE, or renewable energy, hydrogen, bioenergy, green mobility, and CCUS, or carbon capture, utilization, storage. And lastly, energy efficiency. So as such, there is substantial investments to be made in infrastructure and technology. We were just talking about inward investment, collaboration with partners in the regional countries that will certainly lead to numerous benefits for the economy. Green job creation, I think there is a large number quoted as part of the NETR. And GDP upliftment, of course, will naturally be a consequence of the plan, as well as elevation of technical capabilities for Malaysia. So essentially, the plan aims for GHG emissions in the country to reduce by 1/3. Now, at AmBank, we are working very closely with the industry, understanding their business and transition plans, their involvement in the NETR, and thinking through opportunities with them, and solutioning financing options to facilitate moving the needle in line with Malaysia's aspiration of net zero as early as 2050. We have at AmBank participated in large-scale financing, capital market transactions through sustainability, Islamic medium-term note programs, and sukuk programs. We are also a key participant in Bank Negara Malaysia's financing facility for SMEs, the Low Carbon Transition Fund, which includes utilization of blended finance in efforts to green the value chain. We are also offer green financing for initiatives providing environmental benefits such as GHG emission reduction, and have developed a green financing guideline. Here, we have been offering solar financing, solar PV financing as an example, and we also have sustainability-linked loan financing available where interest rebates are tied to achievements of ambitious predetermined sustainability performance targets. So AmBank is also a key participant at the Joint Committee for Climate Change, or the JC3, spearheaded by Bank Negara Malaysia and the Securities Commission Malaysia. And we participate in 3 of their main subcommittees, first being risk management, second governance and disclosure, and the third, the SME focus group. And we're also participating in some of the working groups on risk management as part of the subcommittees. We acknowledge that our transition plan at AmBank is as good as the transition plan of our customers, and therefore we're extremely excited to support the NETR. There are challenges nonetheless. The science and the technologies are new, some untested. Risk appetites will be focused on avenues that are bankable and cash flow generative. And as such, much effort is needed from the government to support through policies and frameworks to create that stability, and also provide incentives. Private equity risk participation and sharing of the risk is important, working with partnerships. And of course, we're looking for blended financing structuring to come into play in the short term and medium term. That we think would assist the country's transition plan significantly.
Amanda, thank you very much. Let me just pick up, there's lots there to unpack, but just one point that came close to the end of your comments. You talked about a blended finance structure, the need for that. Do you just want to say a little more about what you're talking about there?
I think we've started a little bit with, as I spoke earlier, Bank Negara Malaysia has started for SMEs a blended finance structure where there is participation within the private sector and the public sector. So in that particular structure, it's a 50-50 partnership between the public and the private sector, which is Bank Negara funds, as well as funds that come in from the financial sector. So having said that, though, I think more of these kind of structures are definitely needed in order to support financing structures in order to help along with the NETR. So I hope that helps a little bit.
Yes, it does. Thank you
Susan.
very much. Just wanted to get a little more detail around that. Next, going to turn to another panelist who is from ING. That's another firm that Jeffy works closely with over the years. And I've been given permission not to practice my Dutch pronunciation. So I'd like to introduce Martin Hugewerf, who is head of sustainable finance for APAC at ING. And he's a leading voice on achieving environmental and social impact at scale by doing it commercially, which reminds me of a phrase that I have from years ago working in America, which is doing well by doing good. And that's part of what the focus is here. Martin, as a large global bank considered by many as a leader in sustainable finance, what is ING doing in the ASEAN region to transition the most carbon intense parts of its portfolio towards net zero?
Yeah, thank you very much, Susan, and indeed a pleasure to join this panel. Thank you for having me. You position ING as a leader in this space. I think we need to work together and collaborate, and I think we'll have a few questions later on in collaboration. But let me quickly take a step back. If you look at an ING, we are certainly here in the Asian region, we're very much a wholesale bank. Only in Australia do we do retail banking as well. So as a wholesale bank, we cover certain sectors, and these sectors tend to be quite carbon intensive. Think about real estate, aviation, shipping, steel production, the energy sector. They're very carbon intensive, and that means that our own loan portfolio is indeed quite carbon intensive. We've made a commitment a number of years ago in 2017 to achieve net zero and to start monitoring and measuring the carbon intensity of our loan portfolio, of the 9 most carbon intensive sectors that we have in our loan portfolio, and start monitoring that, and then also start steering our loan portfolio in the direction of net zero and tracking that alongside science-based trajectories. That is a big part of our overriding strategy. It's achieving net zero in our overall loan portfolio. Amongst others, what we've started doing last year, also here in the Asian region, is create client transition plans. So we analyze on a client-by-client basis what sort of transition plans our clients have in place today and how they are going to deal with the energy transition over the next number of years, and whether they have 2050 targets, interim targets 2030, for example, and what sort of capex they're going to roll out to achieve those targets. From a bank's perspective, we see that as a massive opportunity to engage with our clients on this topic, because our clients obviously want to make sure that they continue to have access to capital, but they also want guidance. As a bank, we typically are very well aware what's happening in certain industries, and we can communicate what is happening in particular industries to the relevant players and the relevant clients. So stakeholder engagement and specifically client engagement is an overriding tool of what we're doing. Obviously, as a bank, and some other banks have some of these exclusion policies, of course, as well. I think we're one of the leaders in terms of our coal policy. By 2025, we will not finance any coal-fired power anymore. We were one of the first banks to come out with an oil and gas upstream policy on reducing that exposure as well. And most recently, we made a commitment to triple our renewables portfolio. So these are all sort of underlying drivers that help with the energy transition here in the region as well. Now, something that's within my remit is the sustainable finance commitments of ING. And I know we'll be talking about green bonds, sustainability-linked loans later on during this panel discussion, but ING also made a commitment to put 125 billion euros per year to work in sustainable financing. So if you look at the sustainable financing markets today, as they are defined, we really talk about green bonds, social bonds, sustainability linked loans, sustainability linked bonds. So it's really it's cut across both loans as well as bonds. And ING made a commitment to mobilize 125 billion euros per year by 2025. So it's an annual target. Last year, we achieved 115 billion euros. So we're well on our way to achieve that target. Many other banks have similar types of targets. And it is an important topic because it allows us to go to our clients and incentivize our clients to transition. So within that energy transition, from our point of view, yes, we should be financing clean technologies. We should be financing renewable energy projects, but we should also be incentivizing our or more carbon intensive clients. Again, think about steel producers, to reduce their carbon footprint. And we can do that through certain sustainable finance products. And I'm happy to touch on that later as well.
Good. So thank you very much for that. With ING making its commitment next year, no more finance for coal, generation, being fairly aggressive in time terms and in terms of upstream finance and so forth. Do you get much pushback? I mean, have your board, have your colleagues been taken into conversations about how can you do that and what does that do to the economy and that kind of thing? Or is everybody just jump on board?
Well, I mean, so I joined ING 4.5 years ago. So over the past 4.5 years, I've not necessarily seen it as an issue. Now, what is interesting, I think, to note, of course, is that if you want to create environmental impact in today's sort of Southeast Asian region, is obviously dealing with the amount of coal-fired power that's being built up and ensuring that there's a sort of a managed or an accelerated phase out of those coal-fired power plants. Now, for a bank like ING, touching on the coal topic is incredibly sensitive. So that is something that we will likely not be involved with, rightfully or wrongfully, if you will. But there's other organizations obviously dealing with that, and that's an incredibly difficult topic to deal with. But I don't, for example, foresee ING leading on that one.
Okay, no, that's very helpful. Thank you. Let me now turn to Rizal, who's been quite patient. So I'll introduce Mohammed Rizal Azmi, who is currently heading business development at BCX in relation to Bursa Malaysia. And he's playing a key role in the future of voluntary carbon trading. Now, he's an engineer by training and has worked in a lot of different sectors. So seen the world through different lenses. You've worked in manufacturing and power, in the energy efficiency sector, and as an entrepreneur. So very interesting background. Rizal, from an investment perspective, can you tell us how Bursa Malaysia has demonstrated its commitment to facilitating the transition towards renewable energy and the low carbon economy in Malaysia?
Okay, thanks very much, Susan, for the kind introduction. Now, in the tabling of Budget 2022, the government of Malaysia actually mandated Bursa Malaysia to implement the voluntary carbon market. And this would pretty much serve as a precursor or introduction to the carbon markets in Malaysia before a compliance carbon scheme can actually kick in. So hence, on the 9th of December 2022, the Bursa Carbon Exchange, or BCX for short, was launched and held its very first auction of both global nature-based as well as global tech-based carbon credits just about 3 months after that. And we had quite a good response, actually, particularly from the financial institutions, including MBank, who is in the panel today. And this is despite the very nascent stage of the market in Malaysia. And now the VCM is a very important tool in sustainable financing. According to an article released by the World Economic Forum last August 2023, the VCM is currently one of the effective mechanisms in reducing GHG emissions reductions. And it does so very efficiently by unlocking millions of dollars in funds from the private sector every year. And the fact that it is from the private sector is also very important, as it actually reduces the pressure that the government needs to come in and actually fund it. So in addition to these carbon credits, earlier this year, Bursa Malaysia was rebranded as a multi-asset exchange. And in line with that, the Bursa Carbon Exchange also aspires to be a multi-environmental product exchange. Hence, we will also be introducing another environmental attribute called the Renewable Energy Certificates, or RECs for short, in the exchange. And we will start off first by way of auction, planned to be on the 25th of June 2024. And this is also one of the enablers of supporting the energy transition by channeling the funds to the renewable energy projects. So I guess in conclusion, the offerings of both the carbon credits as well as the RECs is one of the commitments that Bursa Malaysia has, in facilitating the transition towards a better or low carbon economy in Malaysia. Thanks.
Rizal, thank you very much. You've said that there has been really quite good response to these early forays into both the carbon credits and the renewable energy certificates. Sometimes at the beginning of something new, you get a flurry of interest and activity. Do you see that interest being sustained over time? How are you trying to keep interest in this?
Yeah, so we do actually have a lot of capacity building to be done, because the mandate given to Bursa Malaysia is not just to develop the platform, but to develop the entire ecosystem. So we've done a lot of engagement sessions, webinars, roundtables, forums, to ensure that the corporate Malaysia is very well educated in carbon markets as well as the RECs markets, which we will launch at the end of June. So there have been, I guess, much better responses as we move through time, and we hope to get more and more participants on board to help support this carbon credits or the RECs as being traded in the platform.
Okay, well, good luck with all of that. So thank you for giving us these quite different perspectives. They speak to a lot of activity and a lot of actual positive action, not just people talking about doing this or that, but actually organizations out there doing it, which is really, really good. Several of you talked about whether it's in the context of hybrid finance or just the context in which you're operating, the importance of policy, in regulation and private finance as well. So it's bringing a lot of elements together. I spoke at the beginning about you're all operating at what I call the frontier in this area. So I'd be interested to hear from any of you who'd like to come back on this question. What about the regulators? What about government? Are they able to, are they motivated to try to operate at the frontier as well? In other words, are they going as fast as those of you who are trying to provide finance or trying to introduce new programs, or faster possibly? Would anyone like to come back and talk about that? Helga, you've got a smile, so let me turn to you.
Smiles are good in this world. Yes, I think it's very important to see much more commitment if we're going to talk about the ASEAN region, to make sure that the high-level transition plans and frameworks and so on actually translate on the ground. And I think that's the challenge, not just in the ASEAN region, but really everywhere. And it is interesting to really come to grips with the way in which a robust policy and regulatory environment is needed to take into account the sheer variation within a region, within a country. For example, if we think about transmission, it's a huge challenge within a single country, the extent to which the transmission infrastructure can be either repurposed or decommissioned. And that does require innovation and a lot of capital to meet the challenge.
Yeah, no, that's absolutely right. Related to this is, and I'll ask the question specifically in relation to the ASEAN region. How are the ASEAN countries approaching the need to balance economic growth and stable energy supply at the same time as going through this transition to cleaner energy sources? It's a question everywhere, but specifically in this region. Again, anyone want to speak up? And if not, I will call on somebody. Martin, let me turn to you.
Yeah, I put a smile on my face, so I was expecting.
You did? That was your signal.
Yeah, I mean, I think they're trying to strike the balance, right? While giving the least disruption to stable supply of electricity and energy, I suppose. And I think, you certainly see in some of the countries here in the Southeast Asian region that there's underinvestment. To Helga's point earlier, there's underinvestment in, for example, renewables. If you look at a country like Indonesia, for example, the pickup of solar and wind energy, and admittedly, it's not the best country for wind energy, but the pickup of your traditional renewable energy solutions is very limited. So I think there's underinvestment happening, and that is the excuse that we often hear is indeed the focus on the need for stable, affordable energy supply to an emerging nation. Now, linked to that, perhaps worth mentioning that in the context of that, we see a lot of conversation around transition finance. So there's a lot of talk in the market around how do we provide more financing for transition, acknowledging especially this particular fact that we're talking about now. In our view, and in the Loan Market Association's view, the existing products that we have, sustainable finance products, and we talk about green bonds or green loans, sustainability linked loans, for example, already help with transition. So I think that needs to be acknowledged, but certainly we need to mobilize a lot more capital for the purpose of transition specifically. And I think we're going to need better roadmaps and or taxonomies to allow to mobilize more capital for the purpose of transition. And these roadmaps, they have to be very localized, right? So to give you an example, hybrid vehicles in, for example, Indonesia would be a great transition asset, if you will, or an asset class, whereas hybrid vehicles in Norway would not be, because they already have 90% plus pickup of electric vehicles. So for Norway would be a step back, for Indonesia would be a step forward. So you need to have these sort of localized transition roadmaps or taxonomies. And I think that's where the regulators can step up and need to take action.
Okay, no, that's I think you're absolutely right. I mean, this is about place as much as anything else, and the different needs in different places. Can I move on possibly to another theme, which is very close to my heart? So one of the things that I do just now is chair a new entity in Scotland called the Fourth Green Freeport, which is dedicated to a just transition to reindustrializing Scotland for a green future. So it's about industry, it's about ports and doing a lot of the things you're talking about, financing, but it's also about regeneration and reskilling and adding jobs, not losing jobs. So it has social as well as environmental focus. The only way this works, at least in our world, is by a partnership or a consortium across private sector firms, including government, both local and national, and also universities and providers of training and skills. So a real consortium and partnership, not easy, but the only way that we can bring this to life. And so I'm wondering, in the ASEAN region, have you been able to leverage international partnerships or climate funds to accelerate the energy transition? And do you see much activity today where public and private sectors are collaborating in order to mobilize sufficient funds for what's needed? Amanda, could I turn to you?
Certainly, I'll give that a try.
Good.
But I guess
there's the smile. Right?
I think Susan, I think that's a very key, important point that I think the countries in the ASEAN have to pick up quickly and then do. I think some have been more forthcoming in terms of being proactive in those in that measure, but I think a lot more needs to be done in the other countries. But I think we have to come to the realization that, on the point earlier, is that there are a lot of political and economic challenges within each of the countries, and the region is extremely complex, right? I think the ethnicities, the religions, the cultures all differ, and we have to find some common point in terms in order to have these kind of discussions. So certainly international partnerships can facilitate, the transfer of, say, for example, learning and sharing from the perhaps more developed nations like China as well as Korea, for example, who can share information and technologies with the ASEAN region on, say, hydrogen. So I think more of that in terms of being able to cooperate and deploy renewable energy technologies more rapidly and efficiently is certainly necessary. I think, as I said, some countries have started, but I think more needs to be certainly done in this particular space.
So collaboration is really important, and providing guidance, as Martin mentioned before, is really, really important. Risa, let me turn to you, and thinking about the development of a carbon credit and wider market. I asked before about how open the doors are, but what else is needed to, and who do you need to be supporting what you're doing to make this work further and faster?
Thanks, Susan. Yeah, perhaps I can also just add a bit to the previous question on the private and public partnership, because it's also what we are seeing at the moment for actually the first Malaysian nature-based carbon project upcoming to be auctioned. And this is also an important collaboration because this project is called the Kuamut Rainforest Project, and it's located in the state of Sabah in East Malaysia. Now, the developer here is Permian Global, which is a highly regarded carbon project developer based in the UK. And they have actually partnered with the Sabah state government via the Sabah Forestry Department, and also the Yayasan Sabah Group via its subsidiary, Rakyat Berjaya. And they also have operational support on the ground from groups such as Pakos Trust and Southeast Asia Rainforest Research Partnership. So this is quite an important element to have because in Malaysia as well as in the ASEAN region, we do not have much experience in developing these sort of carbon projects. So having someone like Permian Global, coming over here and developing this project in partnership with the local government as well as the local parties, this actually enables this carbon project to be developed and to unlock the funding from these types of carbon projects. And this is quite a monumental time for Malaysia as we actually host the first sales of this Malaysian nature-based carbon credits by way of auction at the end of July this year. So that is on the supply side, and of course on the buyer side. Although I mentioned before that the voluntary carbon market as well as the voluntary RECs market is still in its nascent stage, private sector participation is highly encouraged to help unlock the huge amounts of private sector funding available here. And while there are already quite a number of projects, decarbonizing projects that you can do on your own to actually reduce your direct emissions, we also have to realize that there are still a lot of limitations in terms of technology as well as developmental barriers. And we may not be able to reach our net zero 2050 targets, globally if we were to solely rely on that. So funds should actually be channeled to where it can be best utilized at this current.
Okay, so that's very clear. guidance from your perspective, get the money working where it will work right away, and then the rest will follow. I assume you're implying. Just a quick question around technology and innovation. Is there a way that those will be contributing, either of those areas of focus or development, to helping make energy transition projects more financially viable and sustainable? Does anybody want to pick up on either that? Is technology going to help with this? I mean, Rizal, let me just turn back to you in this space.
Yeah, I guess technology is, definitely how to say it, a requirement today, to actually move things faster and at scale. If you look at innovation as well, there's a lot of innovative ways to actually support the transition as well as sustainable financing. Now, I can also share that at least under the carbon markets, one of the models that we are considering in the not so near future is an IPO type of framework to actually financially support the development of these carbon projects from the capital market. So just like the stock market, you can actually purchase shares in these carbon projects and choose to either get a dividend in the form of a carbon credit or a cash, or even a mix of both. Of course, this is still under discussion, and we will also engage with our participants, with the private sector, and find out about the interest and also what could be the barriers in implementing this type of innovations.
Good, thank you very much. We are nearing the end of the sessions, so what I'd like to do is ask a final question, the same question to each of you, but I'm going to ask you to take no more than a minute each to give me a response, so short and snappy. Now, I often hear anyway, it's said that there's plenty of money around, but it just has to get to the right projects and activities, and that's part of what we're exploring here. If there is money to be unlocked, as it were, what's the single action you think could be taken this year, right now, to help unlock more finance in the ASEAN region for the energy transition? Helga, let me come back to you.
Really thorough analysis of what's in the portfolio so that capital can flow. And that means understanding the extent to which the companies into which institutional investors are invested have capacity to transition, and to the extent to which they can do that. So I think that is really key, that deep understanding, the knowledge of transition capacity, what it takes, what is the priority, how can we mobilize this capital for green assets, where should we be engaging with companies, where should we be capitalizing more, etc. So I think it has to start at that level.
Okay, thank you very much. Amana, what's your answer to that question?
For me, fundamentally, I think even before we talk about the technicalities, I think the mindset shift is really necessary. So it's not about postponing action and opting to take it further down the road and take a wait-and-see approach, but more so in terms of trying to figure out what needs to be done right away. Starting small and targeted, I think that would help in encouraging multiplier action and consequences from that decisioning.
Good, thank you very much. Yeah, Rizal, what's your response to the question?
Thanks, Susan. Yeah, hopefully this doesn't sound like a sales pitch or a broken record, but in my view, it is highly encouraged for the private sector to support these carbon projects and renewable energy projects by also supporting the carbon credits and the RECs, which are offered in the market. And with combined effort from both the larger corporates, even the smaller SMEs, we can definitely see a significant improvement in I would say, a relatively simple financing strategy. And as mentioned before, the voluntary carbon market as well as the voluntary REX market can actually help to mobilize these huge amount of funds available from the private sector into this.
Thank you. Martin, what's your response?
Yeah, for me, it's the transition pathways, going back to those. We're seeing some very positive noises come out of Japan with sectoral roadmaps developed by METI. And I hope there's going to be some sort of spillover effect here into the Southeast Asian region as well this year, which I think might be feasible. Certainly not across the whole region, but maybe in some countries there's a proper pickup on those. That's one. Slightly longer term, if I may, and time allows, pricing. Any sort of pricing impact where we can go to our clients and say, hey, if you're financing a green or sustainable, if you're looking for finance for a green or sustainable project, that we can actually offer that at a slightly more competitive price. Because today that's all sort of similarly priced. And obviously that needs to be done through a collaborative effort, including potentially with the regulators and the central banks as well. So I think that's a longer term target.
Right. No, that's a very interesting one, and usually it looks more expensive rather than more financially viable, and so that would be a tremendous shift if that were to happen. Let me just now say thank you very much indeed to panelists. I could go on all day talking to you about these things. We've heard from several of you about underinvestment in the ASEAN region, but we've heard about lots of activity from lots of different lenses, as it were, in terms of trying to build and increase investment. An important focus on providing guidance to your clients and customers, not just the money. You have to help them understand what they can do and how they can use it best. And also about starting small. The way you get this going is not saying you have to solve it all at once, but actually starting with the building blocks. So very good, good messages, and keeping in mind all the differences, ASEAN region to the rest of the world, even though it can benefit from what happens elsewhere, and within the ASEAN region, the differences all around it. So a very exciting time for all of you. Thank you again. And now, Shireen, back to you.
Thank you, Dame Susan and panelists. That was indeed an excellent discussion, bringing in how we can get enough finances for today and the future. We can start small and be strategic. Turning our attention to the UN Climate Summit, let's now hear from Her Excellency Razan Al Mubarak, the UN Climate Change High-Level Champion for COP28, who will provide an overview of the COP28 outcomes relating to finance.
Distinguished guests, it's a privilege to address you today. Warm greetings from the UAE to all participants at the summit, focusing on sustainable finance, hosted by the Global Ethical Finance Initiative and the Asian Institute of Chartered Bankers. The financial sector is pivotal in steering the global economy towards inclusive and sustainable development, especially in the ASEAN region. Addressing climate change and nature loss is urgent. Both are more interlinked than ever before. COP28 marked a significant step emphasizing nature in global climate policy and pushing for zero deforestation by 2030 in line with the Kunming-Montreal Global Biodiversity Framework. It saw substantial financial pledges, including the 30 billion Altera Fund, the 4 billion Africa Green Finance Initiative, and the mobilization of over 600 financial institutions towards net zero ambitions. Additionally, it launched a new capacity building coalition for emerging markets and developing economies, and set the stage for collaborative efforts towards a new and ambitious climate finance goal under the UAE consensus. Looking forward, COP29 in Baku is expected to be crucial for finance, particularly in advancing the new collective quantitative goal for finance to ensure both the quantity and quality of finance. The Climate Finance Framework initiated at COP28 outlines critical actions for facilitating private finance, enhancing project pipelines, and supporting mitigation and adaptations, as well as nature investments. For the ASEAN financial institutions, the call to action is clear. Translate ambition into concrete actions by meeting net zero targets, scaling up renewable energy investments, advancing in adaptation finance, and fostering public-private cooperation. Investing in nature-based solutions is not only a moral imperative, but also an economic opportunity, expected to create over 390 million jobs and unlock $10.1 trillion in business opportunities by 2030. As such, I urge you to support the Nature Positive for Climate Action by increasing investments in nature-based solutions, incorporating nature into climate action plans, and implementing deforestation policy whilst also evaluating impacts on nature. Over 300 businesses and financial institutions are already part of this initiative, and I look forward to collaborating with all of the participants as well as the ASEAN financial institutions as we progress towards COP29 in Baku and COP30 in Brazil, continuing our commitment to nature and climate action. Thank you.
That was an inspiring address from Her Excellency Razan, reinforcing the urgent need to address climate change and nature loss. Continuing on the theme of COP, and to get some insights from the capital markets and banking sectors, it is now my pleasure to invite Sagarika Chatterjee, Department Director, Climate Finance, UN Climate Champions, to facilitate a fireside discussion with the Securities Commission Malaysia and Standard Chartered. Over to you, Sagarika.
Welcome to this session from Dubai to Baku, Driving Climate Finance. My name's Sagarika and I'm at the Climate Champions. We've just heard from the COP28 champion, Her Excellency Razan, on the outcomes from Dubai. But now as we look ahead to Baku, many topics are on the table, including a new finance goal and how Asia will rise to the challenge. Asia holds many opportunities. We've seen this in green bonds. Asia is also impacted tremendously by climate change and contributes enormously to global growth, as noted in a recent IMF report. So we're going to probe some of these topics as we focus on the region and the year ahead. And I'm delighted to have with me two excellent experts from the Securities Commission of Malaysia. With me is Azreen Idayu Zainal, who's the General Manager in the Sustainability Department of the Securities Commission of Malaysia, and also with me from Standard Chartered Bank, Dr. John Merton, CMG, who's a Senior Sustainability Advisor within Standard Chartered Bank's Chief Sustainability Office, and he was previously a Senior Diplomat. Welcome, Azreen. Welcome, John.
Thank you.
So,
Thank you,
John,
Sagarika.
John, I wanted to start with you first. So, as the UK government's former top envoy, you oversaw the World Leaders Summit part of COP26 a few years ago. Tell us, how's the level of interest and engagement from ASEAN countries in relation to climate change changed since then and COP26?
I've seen a very significant increase in engagement on climate issues, particularly in the ASEAN region, since I began working as the COP26 envoy back in 2019. And that ran through the COP process and has been continuing since. And I'd say it's driven by a number of factors. Some of them are external or technological. So, for example, the huge progress we've seen in the scaling of renewable energy, the reducing cost of wind and solar, and also the really significant reductions in the cost of battery storage have made people realize that renewable energy, battery storage, the low carbon economy is going to be the future of economic growth. And that's been seen really clearly even just over the last couple of years in China, with the rise of new energy vehicles now accounting for almost half of vehicle sales in China. So firms in the vehicle industry, sort of the component chain in Thailand and elsewhere in ASEAN, really sense that the low carbon economy is coming, and there's that desire to readjust. And then similarly, there's been political interventions, and none more striking than Vietnamese Prime Minister Chin's announcement at COP26 that Vietnam would aim for a net zero 2050 target, which is really striking, and the first country in ASEAN, major economy in ASEAN, to make that kind of commitment. That's a really striking commitment from a still emerging economy. So we've seen that political commitment as well. And then we've seen it also, things like the European Carbon Border Adjustment Mechanism will essentially mean in the future that we're going to see a pricing in carbon in ASEAN, whether it's happening in ASEAN itself or whether it's happening at the EU border.
Fantastic. And Azreen, in Dubai at COP28, I mean, I think Malaysia had a very significant delegation, maybe the largest participation from Malaysia that we've seen. Tell us, what's your perspective on some of the key outcomes from a climate finance perspective?
Thanks, Sagarika, for that question. I think COP28 was really a momentous occasion for Malaysia. During COP28 itself, we cemented close to $9 billion worth of potential business leads. This is including investments in renewable energy as well as in relation to carbon market ecosystem. Besides that, what is more important is the achievements of some of the negotiations and agreements that were concluded at COP28 and what they meant for Malaysia. I think as we heard earlier from Heshi Razan on some of the funds that have been committed during COP28 itself. There were a lot of those announcements and billions of dollars have been committed. And basically for a country like Malaysia, we are a developing country. Given the pressing challenges that we need to address in order to accelerate climate finance mitigation and adaptation efforts, the financial commitments and pledges at COP28 present opportunities that Malaysia can tap into towards realizing our transition to net zero. For instance, Malaysia, we need approximately around $800 billion for flood mitigation and another $135 billion to fund the transition to renewable energy. Therefore, those commitments that have been made at COP28 really provide vital support that we can tap into to realize our climate goals. And these are things that we are continuing to pay more attention to towards how to tap into all these fundings that will make Malaysia achieve its goals.
Thank you, Azreen. And John, Azreen mentioned some of the financing gaps from the Malaysia perspective. When you were speaking, you mentioned Vietnam. Obviously, alongside the opportunities that you outlined for Asia and the ASEAN region, the region is also a significant contributor to greenhouse gas emissions. And at COP26, again, just looking backwards to kind of look forwards, you led a lot of the negotiations for the Just Energy Transition Partnerships, or JETPs. Tell us a little bit about what your perspective is now on what's happening with the JETPs, maybe a quick recap of what they are and how Standard Chartered Bank is leaning into the JETPs, why they matter.
So thanks, Sagarika. The JETPs, the Just Energy Transition Partnerships, are a series of agreements that have been negotiated with major coal-using countries, South Africa, Indonesia, Vietnam, and more recently Senegal, in order to essentially provide climate finance to those countries in exchange for really robust commitments to phase down coal in those countries. And they're progressing well. And you're seeing, for example, in South Africa, which is the furthest down the JETP road, a really significant amount of renewable energy coming on stream and being licensed in South Africa as reforms associated with the JETP take place. Now, in Indonesia and Vietnam, they're a year behind because they were negotiated a year later. And Standard Chartered Bank, my bank, is a signatory to those. And one of the reasons I joined Standard Chartered out of government was because we realized that for countries like Vietnam and Indonesia to reduce their emissions, they need finance. And that's some of it is going to come from the public sector. But the secret sauce in the JETPs is that public sector finance will stimulate and catalyze a much larger sum of private sector investment. If you look at the Vietnamese JETP, for example, the amount of concessionary capital brought to bear by donors is around $8.75 billion. But the resource mobilization plan is looking for somewhere in the region of $150 billion of investment in the Vietnamese economy to accelerate that transition to a low carbon economy. And Standard Chartered is a part of that. In Indonesia and Vietnam, we're bidding to finance projects. And we're also working to really engage on some of the complex stuff you referenced, like coal phase out. We need to work together to establish how do we bring the financing together to phase down coal power stations ahead of their anticipated end of life, because there are around 5,000 coal power stations in Asia. And if they operate as expected in their economic plans, they will consume about 60% of the remaining carbon budget to 1.5 degrees C that we have as a globe, just those coal power stations on their own. So it's really important to do the financial engineering and work out how do we put an end to their usage ahead of their sort of planned economic lives.
And John, does it feel like there's going to be some tangible results on the JETPs that have started from what you're able to share? And tell us a little bit maybe about the role of diplomacy and advocacy in the region to try and help deliver some of the changes that are needed at the cross-sector level.
Yeah, so I think we will see concrete results from the JETP. They're not a silver bullet, let's be clear. They're not a silver bullet, but they are a really useful way of bringing climate finance to bear on really thorny problems like decarbonisation in a country like Vietnam, where many of the coal power stations are still really young, or in some cases haven't even yet been built, but all the contracts have been signed and so on. And what we see actually with the JETP in South Africa, and I think we will increasingly see in Vietnam and Indonesia, is the JETPs are solving blended finance at a program level. You can arrange blended finance, that is to bring public and private finance together on a project by project basis. But actually you can leverage that concessional finance from donors a lot more if you work at a project level. So if I go back to the example in South Africa, for example, which is the one that's furthest down the pipe, and I wrote about this just recently on LinkedIn if anyone wants to check. What we saw in South Africa was the initial desire was to use the concessional funding to finance renewable energy. And actually, as a result of discussion with donors, it was agreed that actually, if you made a couple of reforms in the generation sector in South Africa, you could finance the renewable energy investment completely privately. And then you could conserve that concessional capital for supporting communities which were going to be affected by the early closure of coal mines and coal power stations. And in a similar way, you're looking at that kind of tension between the provision of finance and reform in order to catalyze the most possible private sector investment that you can using the concessional capital that's available.
Thank you, John. And I just want to go a little bit deeper. So, I mean, the climate champions, we are very focused on the COP and the preparations for that through the year. Those are obviously at the global level. We also work at the regional level. We have regional teams, and we've curated a regional platform for climate projects, which is a list of 60 projects that we think are very promising in developing countries. We hope they will get financed this year. The JETP is obviously more at the kind of the country level. Tell us a bit, with Standard Chartered Bank, I mean, you have a significant geographic presence in the region, but you're also global. Within the context of Standard Chartered Bank's overall approach to sustainability and finance, how do you balance this global, local, national, regional approach?
So we are a bank that's headquartered and regulated in the UK, but unlike many UK headquartered banks, we don't have a retail presence in the UK. So we don't have a sort of a big home market in the UK. In fact, we're present in, I think now 53 countries around the world. And those are the markets that we call home. Our biggest offices, for example, are in Singapore and Hong Kong, and 85% of the bank's revenue comes from Asia, the Middle East and Africa. And therefore we have a tension, as you've identified, between some of the regulatory pressure we face from the UK, where we're headquartered, and some of the experiences we observe in our home markets. And that ranges from things as simple as carbon accounting, for example. We have to use proxy measures in many of our markets for the carbon that we're financing, the emissions that essentially our financing causes, because the raw data isn't simply available in some of the markets in which we operate. So we're really sensitive to that. And we're also sensitive to the need to sometimes roll up our sleeves and get our hands dirty doing some of the difficult things that need to be done in order to decarbonize the economies in which we work. And a concrete example is in respect of the Just Energy Transition Partnerships and financing coal phase out. We had a position that said that we won't finance thermal coal, and on a sliding scale, it's reducing every year the amount of a company's revenue that they can derive from thermal coal, that if we're going to continue to finance them. We've had to revise that position statement so that we can actually provide to finance the special purpose vehicles that will be used to enable coal phase out in certain circumstances. So it's a difficult decision to make. We know it's not necessarily one that's uncomplicated, but we know that it's right to actually engage in financing coal phase out if we're to reduce the operating life of these coal power stations across Asia and meet our climate goals.
Thanks, John. And Nazreen, I want to come back to the capital markets perspective. And John mentioned, the regulatory framework that they face, for example, in the UK, but also other markets. Now, at 28, Malaysia's overarching theme was going beyond, green growth, resilient community, sustainable planet. Could you just share with us a bit how you've been leveraging capital markets for this vision and strengthening the regulatory framework to help provide the enabling conditions for climate finance and green investments, particularly in the Malaysian market?
Thanks, Agarika, for the question. I think before I zoom in to answer your question, I would just like to provide a little bit of context in terms of our policy motivations when we go into sustainable and responsible investment, or SRI. So as you know, Malaysia is a global leader in Islamic finance, and there are all commonalities between Islamic finance with that of sustainable finance. So given this, it was a natural move for Malaysia to move into this space since 2011. Since then, our focus have been into building a facilitative ecosystem for SRI to grow and thrive, and our strategies are very encompassing. We cover all aspects of the ecosystem, the SRI instruments, issuers, investors, internal governance culture, and also information architecture. So all these strategies have already been embedded in our respective master plan and blueprints. And one of the notable efforts that we've done is in relation to the introduction of SRI Sukuk framework in 2014, which is a significant milestone as the framework integrated green, social, and sustainability financing principles within the Islamic capital market framework. And under this particular framework, it saw the issuance of world's first green sukuk in 2017 for the financing of a renewable project. And since then, the framework has been used to finance more than $6 billion of various projects, including renewable energy, green building, affordable housing, education, waste and water management, and many others. All these are projects that are important for Malaysia towards achieving its climate goals. And more recently, we introduced SRI-linked Sukuk framework. This is to facilitate companies in hard-to-abate sectors to transition. And all these frameworks and guidelines that we have put up there are aligned with the global principles and also regional standards. This is very important for us to ensure that our frameworks are interoperable with other regional and also international principles. Within the fund management space, we were the first regulator to introduce a dedicated guidelines to facilitate development of sustainable funds. These particular guidelines provide the framework for the incorporation of ESG, climate change, and alignment with SDGs and others into a fund product. This is again another innovative structure that we have introduced. Besides that, venture capital is also has a huge potential, and this is a segment that we are looking into on how we can further promote green investments through the VCs. As you know, a lot of the VCs out there have already been investing in climate tech. This is an area that is really growing, and they can play a greater role to invest in this area. So to facilitate this, last year we issued a guidelines that will help them in terms of providing guidance on how they can incorporate green and sustainability to get more VCs to invest in green technologies, for example. And besides that, to further provide guidance to the market participants, in 2022, we released principles-based SRI taxonomy that provide guidance on the classification of activities based on green, social, and sustainability objectives. And we are currently working on the next iteration of the taxonomy that will involve the development of plus standards, coming up with thresholds for key economic sectors in Malaysia. This particular initiative also, we are coming up with it in ensuring alignment with the ASEAN taxonomy. But of course, we need to take into account the national policies and targets and also readiness of the Malaysian sectors. And since that we have both regulatory and developmental roles for SE Malaysia, our efforts in championing this looks into the whole ecosystem so that we can further support Malaysia's sustainable development and green growth agenda.
Azreen, that's incredibly helpful, and a lot has been clearly happening on the ground in Malaysia. I wanted to ask one quick follow-up, if I may, which is small to medium-sized enterprises. I mean, it can be particularly challenging, and they're often in many economies, the backbone of the economy. They're much needed. It's where a lot of innovation happens. How do you find the balance yourself in the different regulatory frameworks and guidance in enabling change by market participants and at the same time helping the small to medium-sized enterprises?
In this area, it is important to collaborate. SMEs are really important to the economy. In fact, they provide a lot of employment and also contribute significantly to the GDP of Malaysia. That's why in terms of promoting or encouraging SMEs to go into green and sustainability space, we need a lot of collaboration with the relevant stakeholders. We need a lot of capacity building and awareness building among the SMEs as well. Because since some of them are really small in size, they might not have the capabilities and the resources to learn about new things, to adapt their practices to be more ESG aligned, for example. So this is where a lot of facilitations would be required. And this is where, through our collaborations with the relevant stakeholders, we are providing also in terms of the right practical tools that can help the SMEs to transition faster.
Thank you. And I think we're going to hear more about SMEs later in a separate section in a fireside chat. So as we look out to this year and Azerbaijan, part of Asia and Europe hosting COP29 in Baku, it's being described as a finance COP. So from the climate champion side, fair finance is an important part of this. And for us, that means finance going to developing countries, adaptation, mitigation, and nature, and that climate nature nexus that Her Excellency Razan described earlier. We have many different things that financial institutions can get involved in. Please do reach out to the climate champions. I just want to turn to both of our experts to ask a bit, maybe in 60 seconds, what things do you want to see ahead of this COP this year? And John, maybe if I turn to you first, please.
Thanks, Sagarika. So for a private finance institution like our own in Standard Chartered, for us, the details of the, for example, the next collective quantitative finance goal are less important than the capacity of the private sector to invest in the low carbon economy in Asia and beyond. We need to make sure that there's as much possible private sector investment coming in on the back of any public finance as is possible. And that's the really important thing. So for us, what we want to see progress on is the capacity of the MDBs and other donors to crowd in private sector investment to finance climate projects and so on in Asia and beyond, rather than crowd it out. We want to see progress and resolution on carbon markets and voluntary carbon markets, as well as compliance carbon markets, so that we can help bring together the private finance to support things like early coal phase out across Asia. And we want to see continued progress at a regulatory level around the world to make sure that banks and other financial institutions like my own are incentivized to put as much finance and resources as possible into the low carbon economy and are not penalized for doing that, rather than investing in traditional sectors, which are sort of potentially by some regulators being seen as more secure, more stable and less risky.
Thank you. And just for our audience on the line, the new collective quantified goal that John mentioned, that is the global finance goal that parties need to agree as they look forward. And John, really quick follow-up. Will Standard Chartered Bank have a presence at COP29 in Baku this year?
Yeah, we're planning on having a presence at COP29 in Baku, so hopefully see some of you there.
Fantastic. You know I have to put you on the spot on this, so thanks very much. Azrin, please, from your perspective, what would you hope to see from the Malaysia perspective at COP29 this year?
Sure, Sagarika. I think I share the same feedback that John has mentioned. We want to see the $100 billion commitment to be delivered by the developed countries. We want to see NCQG. We want to see loss and damage fund to be operationalized, among others. These are key climate commitments, climate finance commitments that have been made at previous COPs and also recently at COP28. But specifically for Securities Commission Malaysia, as you know, we are a founding member of the Global Islamic Finance Program, or GIFP, for climate, nature and development that was announced at the recent COP28 as a founding advisory committee member alongside institutions such as Standard Chartered, HSBC, Siemens & Siemens, Ajman University and also WWF. So we are now working towards launching the GIFP at COP29, and a lot of work are being put into this fund at the moment in terms of looking at the structures as well as the criteria and also the KPIs. This fund is about mobilizing blended finance for projects that are aligned with climate and nature, particularly in the global south. So let's hope, we're really looking forward for the announcements at COP29. And this is an area that we are really excited about.
John, Azrin, you've been very generous in sharing your expertise, giving us a sense of what's happened, what lies ahead. And I'd like to thank you very much for sharing those with us. Thank you.
Thank you, Sagarika, Azrin, and Dr. Merton for that engaging session. It was great to hear about the lessons from COP28 and what we should expect at COP29. That brings the first session of Ethical Finance ASEAN 2024 to a close. I hope, like me, you have learned something from our fantastic speakers today and have been inspired to play your part in scaling up sustainable finance in your organization. We will now have a short comfort break, and I will be back to kick off session 2. Welcome back for the second session of Ethical Finance ASEAN 2024. I'm Shireen Kundaya, Director of Sustainability, Marketing and Communications at the Asian Institute of Chartered Bankers, AICB, and your Master of Ceremonies for today's summit. We are delighted to be working with Jeffy and UNEP FI on this important event, exploring how we can further scale up sustainable finance in ASEAN. Remember to join the debate online by using the X handles, formerly known as Twitter, and @FinanceForChange and the hashtag EFASEAN24. Well, enough from me, as we have another packed session ahead with more expert speakers from across the globe. First up is a presentation on the latest developments at UNEP FI, delivered by Maria Eugenia Sosa Tarboda, Membership and Regional Coordination Manager.
Hello, everyone. My name is Maria Eugenia. I work for UNEP FI, and it's a pleasure being with you today. First of all, I really want to thank to Jeffy and AICB for the invitation. It's really a good opportunity to have this conversation with you today. So I will briefly talk a little bit about UNEP FI, our work on climate, and how we see also the climate transition and the future on that. So who is on UNEP FI? Probably most of you already know us. It's a United Nations partnership with the financial sector. Right now, we have more than 500 banks working with us, and we really expect to support our members, to support the financial system, and align the SDGs, Paris Agreement, biodiversity agreements, and other relevant frameworks to support the transition of our economy. We understand that the financial system have a crucial work and a crucial role in this transition. So as UNEP FI, we co-create with the banks, with insurers, with investors to develop guidance, to develop norms, to really support this process. if we look how we work, we have the principles for responsible banking, we have the principles for sustainable insurance, and recently we have UN net zero alliances for banks, insurance, investors. So to commit to 1.5 CISO degree by 2050. These are our main frameworks, the umbrella of our work, but we also look very specific on thematics: climate, nature, resource efficiency, circular economy, pollution, social issues. So it's really a broad scope. And we engage with banks, investors, insurers, but also with regulators and other key stakeholders. But when we talk about climate, I know you have been discussing this in the seminar, but I think it's also important to highlight again and again why banks need to engage on that. So when we look the bank's finance emission, we can say the average is 700 times greater than their operation emissions. So we have the net zero banking alliances to really support financial institutions in this journey. So we really expect that they start measuring their carbon emission. And we know that it's very challenging because sometimes we don't have the methodology, sometimes we don't have all the data we need, but we also believe that we should start from something. So even if the data is not the best one, financial institutions are encouraged to make progress and publicly report their carbon emission in 9 priority sectors. The second phase is really to set science-based targets. That means how they will look the pathways, how they will look the sector transition, and what are their intermediary and the long-term targets to close the gap. So it's not only saying a volume of money that we want to have for renewables or other sustainable initiatives, but what is the carbon intensity of the sector that you are financing? And when looking at your portfolio, how you improve the mix and how you close the gap 2030, 2050. So we have been working 150 financial institutions, providing guidance and try to understand what are the right mechanisms to make this change. And of course, then financial institutions need to engage with regulators, with public policies, with their clients, to be able to make this change. So I won't be on details here about Net Zero Banking Alliance, but I really encourage you to go in our website and to understand how we support our members, and really encourage you, even if we don't have all the answers, even we don't have everything that's in the perfect set, we really need to move forward. And then on the other hand, I think when here with you, I think it's important, that we see there is a lot of opportunities. So we have been discussing with our members, not only how they set targets, what are the methodological process to set these credible targets, but also what are the opportunities. And this is a chart that I brought from the Climate Policy Initiative, that it's very interesting because we see what happened in 2019, in 2020, and what are the needs that we have in some regions. And you can see that 67% of the annual emissions are in emerging economies. So I think here in Asia, how we look those opportunities, how we finance this opportunity, again, with data, with methodology, not only about the volume of money, but also showing that the transition and that there is also credible ways to do that. As in UNEP-FI, I will highlight here 3 publications. We have many others. Again, invite you to look at our website. But about transition finance, I will recommend that you take a look in those 3 publications that we explore more. And here I put in the right side examples of metrics, how we're going to look that in your portfolio, and examples of KPI. So the split of portfolio according to classification, the amount financed, which clients already have net zero transition plans, number of climate solutions aligned with net zero. So I think that we have this challenge to have these key metrics, and here are some suggestions to make sure that we are all in the same page and we are reporting very similar indicators, and then in the future we can measure our progress and we can see how we are moving forward. I also want to take the opportunity to announce that we recently launched the Risk Center. So if we look back, we had a lot of modeling around climate risk. So this month we launched this Risk Center that is combining climate and nature. So this is very focused on risk managers and how they can integrate climate and risk modeling in their day by day. So these initiatives come from a while, not with this name, only focus on climate, but now we will be working on deep working groups to develop new modelings with webinars that we're gonna share what we are doing, technical building workshops, and also a virtual resource hub. Then our members can see everything that have done in the past and take advantage of all this knowledge. So here is how we make this connection on climate and nature. And as we know, in the banks, normally are the same teams doing that. So I think this is a very important development that we need, connecting both nature and climate and integrate and embed in the risk strategy, policies and systems, and of course, products. Last but not least, I want to finish with our members in the region. So here you can have an idea, the countries that we are covering in a pack, the countries and the members. So here is also an invitation to join to UNEP-FI. I think with GEFI and ISCB, we have been doing a lot of events, capacity building, webinars and activities, multi-stakeholder activities, not only with banks, but also with regulators, to make sure that we are building capacity and knowledge. So here is an invitation, because we would like to see more members in those countries, and then you have the experience for peer exchange, have access to resources, and then together we can move forward. So thank you so much for the opportunity. Here I put my our email, our website. In our website, we have a lot of content, a lot of information. So I really encourage you to take a look and learn a little bit. And if you need something, please reach us. Thank you so much.
Thanks so much, Maria, for that excellent update. It was really great to hear about the important work UNEP-FI is doing, and I will be keeping a keen eye on the progress made by the recently launched Risk Center. With small to medium-sized enterprises being the heartbeat of most ASEAN economies, how are they incorporating ESG principles in their business operations, and what practical actions are being taken by regulators, financial institutions, and data providers to support SMEs on their journey to net zero? Well, Carl Chan, Director at Accuracy, will be asking those very questions to representatives of UOB Malaysia, Pantas Climate Solutions, and the SME Association of Malaysia as part of our Greening Finance and Developing SME Resilience Fireside. Carl, welcome. Over to you.
Hi. Hi, everyone. So good morning, good afternoon. So basically, our today's topic is still related to SME and specifically sustainable finance for SMEs. We know that SMEs play a critical role in the ASEAN economies, and it's not less important than the large corps. So that's what we know. And of course, when it comes to sustainable finance or ESG as a whole, it's very important that we bear in mind that SMEs play a pivotal role in terms of our a journey to towards carbon net zero, or towards a transition towards a low carbon economy, and also resilience for our Asian markets as a whole. Okay, so my name is Carl. I am a director at Accuracy based in Hong Kong office. I have been in a consulting career for the past 15 years. And obviously ESG and sustainable consulting is one of my focus areas. I work with banks, I work with associations, I deliver projects for both large corps and SMEs as well. And today, I'm really glad that I'm joined by a few great ladies and leaders in our Asian markets. So they are Dorf, the National Deputy President of SME Malaysia. And then we have Maureen, yes, the Chief Sustainable Officer at UOB, and she's also a co-chair of Joint Committee on Climate Change SME Focus Group. And then we also have Shahida, the COO and also co-founder of Pandas, a leading technology and data solution for climate change in the markets. Okay, so if we are ready, I will jump start to the first question. Maybe I will address the first question to Dov. Dov, so we know that SME is a backbone of the Malaysian economy, and you're based in Malaysia. But to what extent are the SMEs in Malaysia incorporating ESG principles in their business operations?
Right. Hi, Carl. Thanks for the question. So as you rightly said it, SMEs are the backbone of the Malaysian economy. So they are counting about 97.4% of the business establishments in Malaysia. So the question is that as the economic backbone, to what extent, right? To be very, very frank, that if you want to build the SME resilience, let's look at the problem and tackle the issues from the ground and be very honest and transparent. And the general consensus from our members is that there's simply no urgency and no incentives that's good enough to drive the adoption of green financing or ESG for now. And that's in a nutshell. So actually, many of them has heard or know about ESG in one way or another. But the question is there any action that's been taken to adopt in their business, right? Well, mostly no, for sure. And still many of our members are not aware of what does ESG entail. And these three words, that the three-letter abbreviation are somehow definitely relevant or related to them, but not the core of their business or bread and butter. So it's a very low adoption rate generally.
Okay, thanks, Dov. Sounds like there are lots of room to improve, and also that means a lot of opportunities to improve.
Absolutely, yes.
Yeah, so maybe next up for Maureen. Maureen, as the co-chair of the SME Focus Group in the Joint Committee on Climate Change, how do you help SMEs to adopt sustainable and low carbon practices?
Okay, thank you, Carl. And if I can further add to what Dov has actually shared, in Malaysia, we have close to about 1.2 million SMEs establishments, with about 18,000 in the medium size, over 200,000 in small categories, and the remaining are the micro SMEs. And given the different sectoral progress when it comes to ESG, we can expect SMEs' motivations as well as maturity level do varies significantly. And on the ground, I do see increasing number of early adopters SMEs who are mostly those in the supply chain of multinationals and public listed companies, those SMEs in export or sectors where certifications are required. And we do have few progressive ones, especially in the pure play space, who wants to be ahead of the curve. And Dov is correct. Despite the different starting points, studies have indicated SMEs do share common impediments when it comes to ESG: knowledge, cost, and lack of support. And whilst banks have supported the early adopters SMEs. More handholding will be required for what I call the late bloomers, or the majority of the SMEs. And hence, under the Joint Climate Change Committee, or JC3, which is co-chaired by the Central Bank of Malaysia and Securities Commission, the SME Focus Group, or SFG, was formed last August, comprises regulators, financial institutions, ministries, and ESG experts. And we have adopted a multi-pronged approach to guide and help SMEs in the ESG journey. Last year, we launched a one-stop ESG Jumpstart portal, offering SMEs foundational knowledge from step-by-step guide to available training programs, grants, incentive, green financing offered by various institutions, as well as useful resources such as SME disclosure framework. And this portal is relevant for all SMEs, and the intent is for self-learning purposes. And since launch in October 2023, the portal has attracted over 2,000 visitors. And this is just a beginning. We are enhancing the portal to be more interactive as well as up-to-date. And this year, to complement the portal, SFG has planned out a series of engagement programs. And probably this is one area where SFG can work very closely with DOF and the SME associations. So we collaborate with various agencies and associations, targeting SMEs in critical sectors first: manufacturing, energy, agriculture, where the pressure to adopt ESG is more intense. So the program lineup is available on the Jumpstart portal if SMEs are interested to participate. And during the engagement process, we share material ESG topics, from what is ESG to why is ESG important for SMEs and how to kickstart ESG. And more importantly, the session is for us to also gather feedback from SMEs, and also I think to understand from them what has been useful and what more can be done to further accelerate and help the SMEs in their ESG adoption. Back to you, Carl.
Thanks, Maureen. It's very impressive. We can see that how much work you have done to help SMEs to become more sustainable. It's really important for the SMEs and for the overall economy, for sure. And then maybe the next question for Shahida. Yeah, so we know that you are co-founder of Pandas, which is a system or data solution for climate change. What do you see as the major challenges of SMEs when they are facing this transition to low carbon or facing climate change?
Thank you very much for the question. Yes, for us, first and foremost, what we have seen is that SMEs are actually well aware and educated in terms of ESG and sustainability. Of course, as Maureen mentioned earlier, it is very targeted to the SMEs that are impacted in terms of their business. Now, what are the most important challenges that we have seen on the ground? We run a comprehensive program that involves both private and public sectors and private sectors. It goes from the top down, whereby you have anchor companies and their supply chain on board on this program. So the number one challenge is they already have the training. They know how to do reporting and they know how to calculate the carbon emissions. So the number one challenge is, Shaida, what's next? How do we really get the ball moving? How can I differentiate my business from the next SME, from the next supplier? They want to understand how they can really start to decarbonize and tap into the financing. I think that's the number one challenge that we have seen for the SMEs, because as we have also observed, last year, a lot of the conferences centered around ESG, a lot of educational materials, a lot of the banks actually have gone ahead being proactive to educate their SME clients on ESG. So now that they understand, they are now eager to say, okay, how do I now use the information, the data I have in hand, to take it a step further? What is next? What do I do? Perhaps, in order to be able to apply for a tender. So how do I differentiate myself? How do I tap to this green financing to start to decarbonize my operations? And I think that's where the challenge that we have seen in the past few months.
Thanks, Shahida. Yes, I think we cannot agree more with you. I can hear that you're saying, obviously, one of the biggest challenges for SMEs is how to access to green finance. And yeah, this will be my next question for Dolph, actually, to see how you address it or to get your insights. So from your understanding, what are the major barriers that are stopping the SMEs from getting access to green finance? And how do you advise them to overcome those barriers?
Yeah, I think, of course, there are, yeah, thanks, Carl, for the question again. Because there are a lot of efforts that we have seen from the association. We have been approached by a lot of service providers almost every week that they will come back and tell us that there's a lot of solutions available. But then when we go back to the members and talk to them, the common question is always there's lack of need or demand. So there's lack of urgency that drive them forward. Because sometimes you hear that some people say there's a lot in incentives, lack of incentives, but I don't agree personally because I believe in demand and supply. So when there's a need, there's a demand, then there's a desire to look for the best financing options, which could be as what Shahida said, so there's a lot available, which could be banking access or even government or even grant or incentives they are looking for. Of course, when we look at the barriers in a nutshell, let's look at those with more exposure and that require ESG immediately. So those are probably wanting to start somewhere, and ESG adoption is still a challenging effort from them. So the common issues that we have gathered are a couple of them. Number one is like the resources is always very scarce for SMEs, right? With very limited resources in terms of financing capability, human resources, data, and technology, there's always a challenge of setting the priority because they, as I said earlier, it's not their bread and butter. So they don't usually place a very high priority in terms of ESG adoption. So because of that, they don't really look into the financing options. But of course, when we come to priority, that's the question number two already. There's different priorities in their business. So it's not a life and death situation when they don't adopt ESG. That's why ESG is slow because they think that they can always wait. So that's a barrier number two. Of course, number three issue that we always see is that insufficient know-how or knowledge about ESG, especially by the SME owners, whom are usually the top management or the leader within the company. And while they're very much involved in the daily operation of their business. So when the leader, the owner themselves don't have the sufficient knowledge, they actually hold back and wait. So that's another issue why the adoption is slow, and that's a big barrier. So owner apart, of course, their manpower and the human resources aspect, which is issue number four, lack of manpower or the expertise to design, implement and integrate on the ESG system that's sustainable. Because we're not just talking about implementing it today. What's going to continue? The continuous improvement, the continuous measurement, and the adoption later on. You need the internal manpower to actually support that, not just working with external party. So that's another thing that's holding them back at this moment, especially when there's no urgency that they see it. Of course, another issue is that we see there's a lot of lack of accredited certification. So the question is always like who to follow, which is the standard. The most that we have now is like a lot of them are scorecard guidelines. There's no certificate that's accredited by any accreditation body from what we can understand. So although there's a lot of service providers say that you can actually follow my way and it's free to start now, but the question is there's no things as a free lunch. So what's next? What comes after that? So the costing, ultimately, what's the total cost? That's actually something that they hold them back again. So that's another barrier that we look at. And then I think in Malaysia, MITI actually released the IESG framework last year, but they focus on manufacturers only, which is catering only like 5.6% of the total SME in Malaysia. So as Maureen mentioned earlier on, of course, the critical sectors are the main focus now, but then 80% are service-based, right? Although we know that they are not directly involved or affected today, they can't actually not prepared. So, but then the current support from the government only cater for manufacturers. So they are actually at a loss at this moment, like 80%. So what do we do? How do we actually get ourselves prepared? Because there's not enough answer and there's no accreditation. So they all wait and see. That's why at this juncture, we hope that perhaps the government's role and a one-to-one matching effort and help is very important to actually help them to adopt that. So that's my take of the barrier side. All right, back to you, Carl.
Thanks, Dolph. Yes, so we hear from you is about the lack of a priority or it's a lack of resources, and it can be lack of accreditation as well. Yeah, so for Maureen, I know that you work very collaboratively with policymakers, the government, and also financial institutions as well. How do you think you can work collaboratively to drive the priority or to really meet the specific or unique needs of SMEs when it comes to sustainable finance?
I think to help SMEs to access green and sustainable financing, definitely we need cross-sectors collaboration. And I would say there are probably two distinct efforts when it comes to collaboration in this space. I mean, one is between regulator, policymakers, and financial institutions. And the other one that I'm seeing more and more of is initiated by the respective financial institutions themselves with their respective ecosystem partners. So at the industry level, Central Bank of Malaysia, they have this low-cost transition fund, or LCTF, we call it. And progressive SMEs are already benefiting from LCTF. And this is a scheme where banks and regulators provide green financing on a matching basis. And this scheme is a good reflection of how public-private partnerships can play a pivotal role in helping SMEs to unlock, I would say, their ESG opportunities. And of course, one thing that has to be done and needs to be done more of is to increase SME awareness on the availability of LCTF, which is offered to all banks actually. And this scheme is also affordable for SMEs to adopt green practices and covers extensive range of initiatives, from the very simple ones such as installing solar panel to even embedding circularity into the processes or even obtaining green certification. But there's one thing that SME needs to be aware of. Unlike assessing conventional financing, there is governance and transparency aspect that SME has to fulfill when it comes to green financing. And this is to ensure the funds that we actually offer are used for the right purpose and to achieve the intended impact, such as reduction in carbon emission. So that's something that I think a mindset shift that we always have to advocate to SMEs and also businesses when it comes to assessing green and sustainable financing. And the other available financing is Bank Negara's high-tech and green facility. And LCTF funds are for companies that want to go green, whilst HTG funds are enablers for those green tech, digital, and biotechnology solutions. So if you look at it, whether you're adopters or whether you're the enablers of ESG, of green tech, there are affordable funds available at the industry level. And what's also important to highlight is my fellow banking peers in Malaysia have also stepped up their efforts to further support SMEs in their ESG journey. And like what Shahida mentioned, our role is really beyond financing. And I can't speak on behalf of the other banks, but at least from a UOB perspective, we have rolled out series of innovative solutions and programs to help our SME clients transition. And we collaborate with our ecosystem partners. Last year, we launched our UOB Sustainability Compass in collaboration with PwC. And this is a very easy to use tools for SME to assess their ESG maturity stage. And this tool is not a silver bullet, but it is a good structured tool to help SMEs and show them where are their gaps and how they can kickstart and progress on their sustainability journey. And we have also rolled out our U-Series solution. And this is to help SMEs with their decarbonization efforts, whether it's about switching to solar, adopting energy efficient, or even better fleet management. And what we have also seen is through this program, our clients, even the SMEs, can actually reduce their carbon footprint and be more cost efficient in the mid to long run. So what I would encourage is for SMEs to actually talk to their bankers and maybe access our ESG Jumpstart portal to find out more about the various ESG programs and financing that can potentially benefit their business. And whether it's about staying relevant, whether it's about expanding market reach or unlocking new green opportunities, I always share with my SMEs client, the global shift towards sustainability is moving ahead with or without them. And for SMEs, my humble suggestion is always to start assessing their ESG impact to their business, even if they don't start the action, but start assessing how ESG impact their business. And it is better for them to embark on the journey now and carve a competitive advantage when the government grants, incentives, and private capital are available, rather than when the stakeholders start to price in unmitigated risk into the cost of non-compliance or financing later.
Thanks, Maureen. It's very comprehensive. Yeah, very informative. Thanks a lot about the low-cost transition funds, other bank products, and the tools that you have created for the SMEs. So being aware of the time limitation of this section, maybe I will just go directly to a final question. So it's a $1 million final question. In 10 seconds, how do you describe the single biggest action that can be taken to help unlock sustainable finance for SMEs? Any ideas?
Yes, perhaps I can share.
Okay,
I think
please, Saida.
in 10 seconds, I think the answer is to help the SMEs to measure, manage, disclose, and gain access to financing to move ahead.
Yeah, nice.
And then perhaps if I can expand, can we expand, or that's it, 10 seconds, so I can pass on to the next, it's fine.
Yeah, so just to make it quick, and also for Dov and Maureen, any last words you want to say in regarding to how to help the SMEs?
Just a quick one, I think. I just want to say that I think for SMEs can run, but for sure cannot hide, because we must be ready and catch up and not lose out, no matter how, because we are all connected via a global supply chain. So we have to give up.
That's true. Yeah. And for me, there is no one single action, but I do think we need many small actions, but needs to be coordinated cohesively to really help SMEs to be ESG ready in a big way.
Yeah, thanks. So maybe I just come to our conclusion for this section then. Yeah, from your sharing, I'm seeing very positive messages, a lot of opportunities or improvement opportunities for the SMEs to adopt sustainable finance. And from Maureen, it's great that you're saying that in Malaysia or in the Asian economies, there are lots being done actually to help the SMEs to gain access to sustainable finance or to transition to low carbon economy. Also from Shahida, you're offering great data and system solutions, etc., to help the SMEs. So I believe the future is bright. So hopefully we are going to see more and more progress in sustainable finance for SME in the next few years. Thanks a lot for joining me in this discussion. Thank you.
Thank you, Carl.
Thank you.
Thanks, Carl.
Thank you.
Thank you.
Thank you, Carl and colleagues. The key takeaway for me was the need for SMEs to better understand and engage with the ESG movement. There were a couple of very practical examples as to the support available to SMEs. Nature and biodiversity risk is moving up the finance agenda at pace. It is therefore a pleasure to welcome Candice Dott, Director of Market Engagement from the Task Force on Nature-Related Financial Disclosures, or TNFD, as it is more commonly known, to share an update on this market-led, science-based and government-supported global initiative.
I'd like to start by thanking Shireen for the kind introduction. I'd also like to thank the Global Ethical Finance Initiative and the Asian Institute for Chartered Bankers for the invitation to speak at this Ethical Finance ASEAN conference. My name is Candice Dott, and I head up our global market engagement for the Task Force on Nature-Related Financial Disclosure, also known as the TNFD. I'm based in Johannesburg, South Africa. Today, I'll share a brief introduction to nature finance and the TNFD recommendations, as well as the tools that you can use to get started. What TNFD have developed is a way of understanding nature. Many in the room will have a common language and a common way of understanding climate, which is built from the Greenhouse Gas Protocol and integrated into the TCFD disclosure framework. What TNFD have done is to draw together leading thinking to help you understand nature and how it matters to business. One initial example to help you understand nature is through the 4 nature realms, which is basically a helpful way to show that nature has fundamentally different components across land, ocean, fresh water, and the atmosphere, which is where climate comes in, as well as air quality. And you can see the society aspect, us, at the center interacting and across all 4 realms. You'll also hear the word biodiversity used, and I want to remind you that biodiversity is the variability among living organisms across the 4 nature realms. This includes ecosystem diversity, species diversity, and gene diversity. We know that most companies, investors, and lenders today are aware of the extent of biodiversity loss in general, but are really struggling to understand their own impact and exposure to nature-related issues, what we refer to as dependencies, impacts, risks, and opportunities. And these businesses are inadequately accounting for nature in their strategies and their capital allocation decisions currently. The TNFD recommendations provide companies and financial institutions of all sizes with a risk management and disclosure framework to identify, assess, manage, and where appropriate, disclose nature-related issues. The TNFD has developed a set of 14 disclosure recommendations and guidance that encourage and enable business and finance to assess, report, and act on their nature-related dependencies, impacts, risks, and opportunities. Our aim is to shift the global financial flows away from nature-negative outcomes and towards nature-positive outcomes, aligned with the global biodiversity framework. The TNFD is a global, market-led, science-based, and government-supported initiative to help companies and financial institutions factor nature into their decision-making. We have 40 task force members from all over the world, many of whom represent real economy sectors who have major impacts and dependencies on nature, as well as financial institutions and market service providers like the Singapore Exchange. I would also like to emphasize that our work goes well beyond the task force itself. We have a TNFD forum, and any organization who is supportive of our mission can join the TNFD forum. And I really encourage you to do so by going to our website and joining the TNFD forum. We currently have over 1,500 members of the forum, and our forum allows you to stay in touch with what the task force is doing through knowledge sharing, capacity building, joining various webinars that we host, and regular newsletters. Plus, it also allows you to contribute to our further developments. We also have a number of regional consultation groups. We have one here in the ASEAN region, led by WBCSD. We also work with many data providers, because one of the common themes that often comes up is there actually data available to do all of this? As a result, we've been working with really innovative data providers to challenge them around what is possible now and also what is going to be needed to help make things more accessible and possible going forward. TNFD is a voluntary initiative, as I've said, market-led, and has developed a set of recommendations for the market from the market. We are not developing a standard and we are not developing regulations. But it is worth knowing that the TNFD has worked closely with the Global Reporting Initiative, the International Sustainability Standards Board, the ISSB, from the very outset, learning from what they've done, drawing from what they've done, and now they are drawing from the TNFD. We know that the ISSB's work on biodiversity and ecosystems will have a significant influence on the future development of disclosure requirements across Asia and globally. The TNFD welcomes the recent decision of the ISSB to commence work on nature-related issues, drawing on the recommendations of the TNFD. This is a critical next step in developing a global baseline for sustainability reporting following the release of the IFRS S1 and S2 sustainability reporting standards in 2023. This ISSB recent announcement is yet another important step forward for nature-related corporate reporting. I also want to highlight the recent updates of the GRI Biodiversity 101 standard, which is also drawn on the TNFD's recommendations. The further incorporation of nature-related issues into the global reporting baseline, drawing on the work of the TNFD, will provide investors, report preparers, with a more integrated approach across governance, strategy, risks management, metrics, and targets. It will also help to realize the achievement of the Target 15 of the Global Biodiversity Framework. A few takeaways from our technical team's recent trip earlier this month to Singapore, where Emily McKenzie and Tom Haggerty both attended and participated in various sessions during Ecospirity Week. They both came back sharing absolutely fantastic local examples of TNFD adoption framed around business models and value creation, rather than just compliance aspects of reporting. Emily and Tom both shared how much interest there was in TNFD during their trip, which further reaffirms the overall ASEAN region's momentum within sustainable finance and the overall support and interest from policymakers, business leaders, standard setters, companies, investors, banks, and civil society at large across the region, which we are seeing firsthand. Emily and Tom also got to interact with many TNFD early adopters, some of whom have already publicly shared their first TNFD reports. Some of those companies include SMBC, UOB, CDL, and the Norges Bank Investment Management Team, just to name a few. We now have over 370 organizations as of last month adopting TNFD from more than 45 countries, representing an excess of $15 trillion in assets under management. And we have already committed to start making disclosures. These companies have already committed to start making disclosures based on TNFD recommendations. This includes 25% of the world's systematically important banks. An increasing number of leading asset owners and asset managers are now also calling for TNFD-aligned disclosures through their stewardship guidelines and activities with investee companies. This has all been achieved only 6 months after the publication of the TNFD recommendations in September last year. While climate and biodiversity are directly connected, climate impacts are relatively easy to measure in terms of emission levels and temperature changes, but biodiversity is a great deal more complex, and I do not want to overwhelm you with much more detail. But if I can leave you with a short overview of TNFD, and if you only have time to read one document available on our website, I would strongly recommend you start with the Getting Started with TNFD guidance. Then you can move on to our LEAP approach, which stands for Locate, Evaluate, Assess, and Prepare, which is the process many organizations are using to help identify and assess their nature-related issues. The conference title, Scaling Up Sustainable Finance, aptly summarizes the tangible and growing focus we are seeing through our TNFD adoption and reporting trends. And I'd like to emphasize the strong uptake in TNFD adoption across Asia and the Pacific region, particularly seen through Japan, Taiwan, Singapore, Australia, China, Malaysia, and the Philippines and Thailand, as well as many other countries. But please do contact me for more information if I can help. I look forward to hearing from Nicole at Planet Tracker, and I personally enjoy seeing updates from the Planet Tracker team, who helpfully share their unique insights and investor toolkits, such as the recently launched Nature Scorecard dashboard, which draws on the 320 TNFD early adopter listed organizations as one of the set of voluntary inputs they use. I'm sure you're going to hear lots more impactful Asian market corporate updates. Thank you.
That was a very helpful introduction to nature finance and the TNFD recommendations and tools. Thank you, Candice. I would now like to invite Nicole Kozlowski, Head of Engagement at Planet Tracker, to outline the extent to which ASEAN-based corporates are engaging with TNFD and other nature-related initiatives and frameworks.
Thank you for the introduction. I'm delighted to be here today and would like to thank the Global Ethical Finance Initiative and the Asian Institute of Chartered Bankers for the invitation to speak at Ethical Finance ASEAN 2024. Today, I will speak to you about how corporates prepare themselves to start taking nature and biodiversity into account, We will look at the initiatives out there, whether corporates are signing up voluntarily or whether they're being identified by financial institutions as key contributors to nature loss, and dive deeper into companies from ASEAN countries. So, with that being said, which companies do financial markets recognize as having significant nature exposure? To answer this question, we have identified key nature initiatives, both voluntary initiatives, meaning these companies have chosen to sign up to them, and involuntary initiatives, meaning initiatives where investors and other groups have selected companies which have the highest impact on nature. Our scorecard examines over 470 corporates who are involved across 7 nature frameworks and initiatives, and looks at 3 voluntary and 4 involuntary frameworks. The 3 voluntary initiatives include the Task Force on Nature-Related Financial Disclosures Early Adopters. It also includes the Science-Based Targets Network's Nature Target submissions. And we also include whether these companies have appointed an executive responsible for nature. We then also included 4 involuntary frameworks where companies have been selected by financial markets as having an impact on nature, such as the Nature Action 100, the PRI Spring Initiative, the Forest 500, and the Pesticides Working Group. Now, I would like to zoom into a couple of these initiatives to highlight their ambitions. One of the key initiatives is the Nature Action 100. They are a global investor engagement initiative and have come up with a list of 100 companies across key sectors. These key sectors have been identified as sectors which are systemically important in reversing nature and biodiversity loss by 2030. The sectors identified include biotechnology and pharma, chemicals, consumer goods retail, food, forestry and paper, household and personal goods, and metals and mining. The companies selected will all be part of these sectors and will be engaged with. Another key initiative is the Principles for Responsible Investment Stewardship Initiative on Nature called SPRING, which was launched in October 2023. Instead of focusing on multiple sectors, they have taken the approach to focus on forest loss and land degradation as a driver of biodiversity loss as a first step. On the slide, you can also see the other drivers of biodiversity loss, and it might well be the case that the PRI will expand to cover other areas at a later stage. The PRI has identified 40 companies with the largest impact on forest loss and land degradation, and will start engaging with these companies later this year. As mentioned, both initiatives have set out target companies. What is interesting is that there are 6 companies which overlap between these initiatives, these being Archer Daniels Midland, BASF, Bayer, Bunge, China Mengniu Dairy, and L'Oreal. There are a few other initiatives out there which we have covered in our scorecard. 2 other involuntary initiatives are the Forest 500, which is led by Global Canopy, and the Pesticides Working Group organized by Share Action. But I would also like to highlight the voluntary initiatives. One of the key initiatives is the Task Force on Nature-Related Financial Disclosures, which rolled out their voluntary framework in late 2023. With the rollout, they asked for early adopters to step forward. 184 organizations indicated a willingness to publish their TNFD disclosures for the 2024 financial year or earlier, and a further 135 intend to have this in place for the 2025 financial year. Another organization pushing ahead with nature reporting is the Science-Based Targets Network, SBTN. In May 2023, it launched the first science-based targets for nature, and an initial group of 17 global companies are preparing to submit targets for validation. Just to note that there are a few other initiatives out there, such as the Business for Nature's It's Now for Nature campaign, the CDP's reporting, which will align with the TNFD, and the Global Reporting Initiative, GRI, which will bring their updated biodiversity standards into effect from January 2026. Lastly, we also included whether corporates have an identifiable executive that is responsible for nature. And to date, we were only able to find 5 corporates which have appointed someone. These include Arup, Basswood Corp, Bellway, Burberry, and Geopark. Now, Diving into ASEAN companies, we can break down how they score on the Nature Scorecard. In total, 29 companies from ASEAN countries are represented, with the majority coming from Indonesia, followed by Malaysia and Singapore. A little less than half of these companies are part of the manufacturing sector, mainly food manufacturers, followed by mining, quarrying, and oil and gas extraction businesses, as well as agriculture, forestry, fishing, and hunting businesses. Now, looking at the voluntary participation, almost half of these companies, 12 in total, have signed up to be early adopters to the TNFD, but none of the companies are submitting science-based targets for nature or have an appointed head of nature at this stage. When it comes to the involuntary initiatives, both the Nature Action 100 and the PRI Spring initiative have included 4 companies from this region, whereas the Forest 500 includes 10 companies on their list. You can see a breakdown of the companies on the slide here. There are a couple of interesting observations when we look at the list of companies. For one, it is interesting to note that the companies which have been identified by financial markets to have a large impact on nature, none of them have signed up to voluntary initiatives such as the TNFD or the SBTN. And another interesting point is that in our scoreboard, there is only one company which is identified by both the Nature Action 100 and the Forest 500 as having an impact on nature, which is the company Sima Darby Plantation. Our tool is publicly available on our website, and you can dive deeper into the individual companies there if you like. And this brings us to the end of the presentation. It was a pleasure to speak to all of you today. And again, I would like to thank the Global Ethical Finance Initiative and the Asian Institute of Chartered Bankers for putting together this great event. Thank you very much and goodbye.
Thank you so much, Nicole. It was great to hear about how ASEAN companies are doing on Planet Tracker's Nature Scorecard and the 12 who have voluntarily signed up for the TNFD, which Candice previously spoke about. Continuing our focus on nature, we now turn our attention to unlocking finance for nature-based solutions. This exciting panel will be moderated by Laura Canas de Costa, APAC Policy Lead at UNEP FI, with insights shared by Global Alliance for a Sustainable Planet, Federated Hermes, Forest Fund, and MSCI. Over to you, Laura.
Okay, and so thanks again. I'm thrilled and it's really a privilege to welcome you to this panel discussion on unlocking finance for nature-based solutions in Asia. The topic really couldn't be more timely. The Asia-Pacific region is home to some of the world's most mega-diverse countries. The latest report by the Intergovernmental Science Policy Platform on Biodiversity and Ecosystem Services highlighted again that Asia Pacific is home to 17 of the world's 36 biodiversity hotspots. The region, of course, at the same time supports over 4 billion people, many of whom rely directly or indirectly on biodiversity for their ecosystem services that nature and biodiversity provide. The World Economic Forum estimates that actually as much as 63% of the region's GDP is potentially at risk due to nature loss. And this is a problem since the region faces relentless pressures stemming from rapid urbanization, from deforestation, pollution, and of course, climate change. And these factors together are accelerating biodiversity loss at quite an alarming rate. 60% of the region's grasslands are at risk of degradation, and nearly 25% of endemic species are also under threat. So as the impacts of climate change intensify, the need to integrate ecological health into our economic systems has really never been more urgent. Strategic investments in nature and biodiversity are called for, which could not only mitigate these risks, but also generate substantial economic benefit. So S&P estimates that investing in nature-positive business opportunities could potentially generate over $4 trillion by 2030. Addressing these challenges requires a substantial shift in how we all value and finance nature. And by unlocking finance for biodiversity, the Asia-Pacific region can really lead by example here and demonstrate that economic growth and environmental sustainability can really go hand in hand. So with that introduction, I am delighted to welcome 4 fantastic and very knowledgeable speakers to explore this topic in depth today. So we have with us Satya Tripathi, who is the Secretary General of the Global Alliance for a Sustainable Planet. We have Andy Turnbull, Senior Investment Manager for Natural Capital at Federated Hermes. We have Datuk Jeffrey with us, who is the CEO of the Malaysia Forest Fund. And last, Jurgita Balaisaite, who is Vice President, APAC ESG and Climate Research for MSCI. I'll start with an opening question for all of you. And Satya, to get the discussion started, it would be really great if you could give us just an overview of what nature finance means and a little bit more detail on the risks that nature and biodiversity loss pose to ASEAN economies.
Thank you, Laura, and greetings, everyone. It's wonderful to be here today to discuss something which is at the core of everything we will do and experience over the next decade. If we survive this, then possibly the next and the next. And why I say that is because that's central to your question, Laura, is that we have ignored nature for far too long. Everything that humans use for their survival, everything, there are no exceptions to that rule. Everything comes from nature. And we have somehow magically believed that there is no end to that giving, Nature will just keep giving, even if we keep destroying it. And that's now finally coming home to roost. And to give you an example of the ASEAN region itself and the challenge to nature and biodiversity, 2 of the biggest economies in ASEAN, which is Indonesia and Malaysia, draw heavily from oil palm and the economy around it. If you look at latest research, up to 10% of the emissions on land use and land use change has come from palm oil. And as much as it has strengthened these economies and brought a lot of people out of poverty and done amazing things for the economies that have relied on palm oil for their economic growth, but it's time to stop. Stop, not as in stop growing palm oil or oil palms, but stop getting into the forest frontier and destroying it and do nutrient mining to advance oil palm. Because in both these economies that I mentioned, and I have worked extensively on those when I was working in that region as a head of the UN's Red Plus office, UN OCID, if you take the case of Indonesia alone, there are about 7 million hectares of degraded oil palm that you can actually replant, find the resources, and produce at twice or thrice or even 4 times the efficiency as compared to now, because they are degraded, so they actually produce at anywhere between 25 to 40% of the normal efficiency of oil palm. And you could actually revamp the economy and bring back prosperity to these communities without touching a single forest land, a single acre of forest land. So, so the opportunities are right there. We have to see the opportunities for what they do for people, but equally what they do for planet in not damaging the pristine rainforests that are such an amazing heritage of nature in both these countries and many other countries in the region. Talking about Asia Pacific, if you take the case of India, talking about sustainable agriculture, to have agriculture done properly, you need about 2.5% soil organic carbon. In most parts of India now, the soil organic carbon has dropped to 0.4%. You're literally a few crops away from starvation if you don't take these things seriously and try to rehabilitate the land, bring back the ecosystems, focus on ecology and not just economy, because ecology will bring you growth and prosperity for everybody at the bottom of the pyramid. especially talking about the economy. Thank you.
Thank you so much. Maybe shifting a little bit actually to the global investor perspective, Andy. So Federated Hermes, of course, is all about providing sustainable wealth creation. Could you share how your investment approach generates returns while at the same time watching out for the environment over the long term?
Yes, sure. Thanks, Lauren, and good to be here. So Federated Hermes is an active asset manager and has always been at the forefront of responsible investing, as we do have the conviction that responsible investing is the best way to create long-term wealth for investors over the long run. In my role in the Federated Hermes Private Markets Natural Capital team, we are seeking to generate long-term attractive financial returns through the preservation and restoration of nature and biodiversity. We currently mainly do this via the UK Nature Impact Strategy by investing directly into real assets like woodland creation and woodland restoration projects, peatland restoration, and other habitat types such as grassland, trying to restore important grasslands as well. We also invest into nature-based supporting infrastructure businesses. And when we package this up and combine it in one portfolio, this offers diversified multi-asset exposure for investors that has revenue streams that are nature-based and exhibit low correlation to traditional strategies. And overall, our approach is science-based and impact-led. So that's very much baked into how we think about and assess our investment opportunities. And we are aiming to provide investors exposure to fast-growing nature-based markets like carbon and biodiversity. But we are also working with traditional revenue streams from natural capital, such as timber, which again, when we combine these just multiple sources of nature-based, some of them newer, some of them older, when we combine these together to generate the financial returns, we can do that whilst enriching the environment by focusing on nature first. So it's not necessarily if we look at a particular site to create a new forest, it isn't timber above all else, or production above all else. That may form part of it, but it's really starting from the base of what is the best ecological solution for this site. How do we incorporate revenue streams within that we can generate these returns?
Fantastic. Thank you so much. I would like to turn to you, Dr. Jeffrey. So we've heard on a little bit already from Andy around innovative finance strategies. How does the Malaysia Forest Fund focus on this and the kind of interventions that you lead to support forest conservation?
Thank you, Laura. Malaysia Forest Fund actually is a federal agency under Malaysia Ministry of Natural Resources and Environmental Sustainability. Our primary mandate is to mobilize the financing that bolsters forest conservation efforts. Our first mandate is to develop and operate the Malaysia RED Plus Finance Framework, RFF, building upon RED Plus framework by the UNFCCC. So this framework serves as a guiding structure for our financial intervention in forest conservation, while observing the sustainability benchmark, as well as aligning with safeguards that protect our community and biodiversity. RFF is developed with two key financial instruments. The first one is the Forest Conservation Certificate, FCC, which operates as a non-market-based instrument. It focuses on certifying sustainable forest initiative while offering tax incentive and facilitate sustainability reporting for corporations that contributes financially to forest conservation efforts. This instrument not only encourages corporations to invest in conservation, but also rewards them for their contribution. And the second financial instrument under the RFF is the Forest Carbon Offset, FCO. Unlike the FCC, the FCO is a market-based instrument that leverages on existing framework that assign economic value to the preservation of forests. By monetizing the carbon sequestration and storage capabilities of forests, the FCO incentivizes private sector involvement in keeping the forests intact, akin to the carbon crediting mechanism. So both instruments are expected to play a crucial role in promoting private sector engagement in the forest conservation. They provide tangible benefits and incentives also for corporations to participate in conservation effort, which in turn helps mobilize private finance towards this initiative. So this approach is particularly significant strategies as it shifts the financial burden from being solely government funded to a model that involves public and private partnership and encourages corporate responsibility. While developing innovative finance strategies are part of our mandate, implementation and operationalization of these instruments, though through communication and capacity building, as well as coordinating between various stakeholders, are part and parcel of this endeavor. To elaborate, I would like to share a little about the Malaysian context. What may be unique for Malaysia is the fact that when it comes to land and forest-related matters, it is under the autonomous administration of the state governments, while the driving force in advancing nature-based solution comes from the private sector, entities and financial institutions, motivated primarily by the shift in priority of the landscape towards sustainable development. So in developing financial instruments that are usable, practicability and market accepted, we have had extensive and close engagement with various stakeholders in Malaysia, including the federal and also the state government, entities in the private sectors, financial institutions, academia, and also the NGOs. Those follow us on social media would be aware that this extensive engagement has culminated in our FCC having been approved by the National R&D Plus Technical and also the steering committees for the operationalization, and the FCC will soon be launched for public use. So at the same time also, our FCC is undergoing a feasibility study to be used as a forestry-based domestic offsetting scheme. So this study is due to be completed in May 2024, which is a few short weeks away, and we will be finalized with one proposed initial methodology based on the market requirement. So this development should provide a clear insight into what Malaysia Forest Fund is about and embodies the mandate that MFF has been established, on which are in the context of forests and also forestry. Firstly, is to develop and implement innovative finance strategies, to develop associated guideline protocols and procedures to enable and operationalize forest initiative, to facilitate communication, awareness, and capacity building, and lastly, to verify and report on initiatives implemented. That's all. Thank you, Laura.
Thank you so much for giving us a glimpse into this really important work you're doing. And on the government, the role of the government, public-private partnership, I hope we can come back to this a little bit later as well. So Yogita, for these market-based mechanisms and innovative finance that Dr. Jeffrey and Andy already discussed, of course, we need a lot of data. And I wanted to start this question with you. What progress has actually been made from your perspective in ASEAN on these data challenges that financial institutions face when they're trying to assess and address nature-related risks and impacts?
Hello, everyone, and thanks, Laura, for the question. So perhaps I can start with a brief introduction about MSCI. And so we provide stock indexes, portfolio risk, and performance analytics tools to institutional investors, hedge funds, and all sorts of investors. And perhaps MSCI is best known for its stock indexes, which focus on different geographic areas and different stock types. They track the performance of those stocks and included in them and act as a base for the exchange traded funds. And I guess specifically where I sit, I come from sustainability and climate team, and we actually mostly do research that is focusing of how companies are managing climate and sustainability related opportunities and risks. And a lot of our clients that we see come to talk to us about how they can identify activities of the investee companies that are interested or comes in those indexes that could lead to nature, but basically loss, or for example, how to measure those negative impacts of the investee companies, or also to understand how those different nature-related risks can translate negatively into the company's financial performance as well. So we both look at the risk and the opportunity. And specifically when we talk about the data, we definitely see a positive progress in ASEAN as well. And I guess it could be attributed to some of the global biodiversity-related frameworks such as TNFD coming into force and providing some guidelines broader how investors and also the corporates can approach the topic of biodiversity. However, I guess like some of the challenges in that progress we're still seeing is that there are still perhaps first of all is because biodiversity is such a complex topic, right? So in terms of even terminology, understanding it, so there is still a lot of challenges related to that. And also I think also even for the more advanced investors, I guess sometimes it's even difficult to understand and know what tools are available, what factors are available, and where they can start. And I guess lastly, even what's also quite challenging still, even understanding, while we can understand certain risks at a portfolio level, but reaching that location-specific assessments is quite still challenging. And we talk about when we talk about the biodiversity, that location element is very important. So I think perhaps those would be those three high-level type of challenges that we are seeing, and then all of the progress that we have seen so far.
That's really helpful. Thanks a lot, Yogita. And I hope you can come back to TNFD and some of the specific metrics later on as well. So to deep dive a little bit on this aspect of actually scaling market mechanisms for nature-based solutions, I wondered, Satria and Andy, I'll put this question to both of you, but staying a little bit still at the high level, what, according to you and the quite different stakeholders and that you represent, what are the key barriers to attracting more investment in nature positive projects? And if you could maybe actually also already highlight some of the ways these might be overcome. Maybe starting with you, Satri, and then handing over to Andy.
Thank you. Well, the barriers are that there is little data available as to how these investments work out. There are very few case studies, very little understanding of, there's a lot of understanding of risks through the conventional lens, because all investment is about understanding risk, measuring risk, managing risk, and then getting returns. So everything is understood through the brown economy lens, where nature is invisible. So if nature were to be visible in that conversation, it will be the biggest risk we are talking about, and which we are not. To give you an example, something we did, it's almost 8-9 years now, back in 2016 in Indonesia. At that time, I was working pro bono, but with help from the UN Environment Program, with the help of the then head of UNEP, my good friend Akim Steiner, who contributed close to $500,000 to set up something called the Tropical Landscape Finance Facility, which I actualized and set up, working outside the UN system. And what did we do? We built a partnership between all stakeholders with the government, but the government not playing a money role or a regulatory role, but a more benevolent role, a facilitating role, with Pa Jokowi and Pa Luhut at that time, and they're still, it's the same government still there. And then partnering with BNP Paribas, World Agroforestry Center as the research partner. And we managed to, and with a bit of blending from USAID, and the asset manager was the ADM Capital out of Hong Kong, together, we managed to catalyze, and Michelin, of course, was the entrepreneurial partner, to protect a 400,000 hectare forest, which had already lost 22% of the land to poaching and illegal logging and everything else. And so Michelin comes and puts up this world's largest sustainable rubber plantation, 38,000 hectares, which was completely degraded. WWF International comes in and puts in a 50,000 hectare conservation area, bringing back the forest. That's the second ring of defense. It employs 50,000 people, 16,000 directly in the rubber plantation and 34,000 in the secondary and tertiary sectors of the economy, without a single dollar of government money. And the first tranche money, which we raised out of Singapore, $95 million, was at a cost below the sovereign borrowing cost of Indonesia, the country. And this was project finance on degraded land, and Michelin didn't want even recourse to its books. It was a miracle of sorts by building a narrative around Mother Nature and what it does to the Sumatran tiger, the orangutans, the pangolins, and the rainforest and everything else. And this is the most important part there. The bond, the first tranche was a 95 million bond, 15-year bond. But 5 years later, the project becomes so successful and cash flow positive that Michelin actually buys out their joint venture partner in Indonesia and takes the whole thing onto its books and retires the bond in 5 years, pays off everybody, because now it can actually get money at lower costs because there's a collateral of 38 million rubber trees. So, so there are very few examples like this, of course, but at the same time, these are very powerful examples of what happens when a diverse set of stakeholders come together with the right motivation, not about making 15, 20, 30% returns, but to focus on the forest. How do we bring back the forest? How do we prevent any further deforestation? And how do we make it all work? And then everybody actually ends up making money, not outsized returns, but reasonable returns as compared to the market. And it works, actually. So my take on the matter is that there's significant opportunities and possibilities waiting for us to tap into, provided we build these virtuous partnerships among all stakeholders, such as the ones in this conversation.
Great. Partnerships and bringing different stakeholders together, I think really does the trick, especially in the area of nature. Andy, is that a fair reflection of the main the main barrier and how to overcome it, or would you what barriers do you face on a day-to-day basis?
Yes, so that's that's a fantastic case study. I think if I talk a little to when we are engaging with investors raising capital for these activities, for many of them it's a new asset class nature. So we've spent a lot of time at Federated Hermes and with our partners to try and to integrate how these systems, these ecological systems, how these natural capital activities like forestry, like peatland restoration, how they operate by utilizing that. There are professionals that exist in this space that have, they've been forestry people, they've been foresters for decades, they're very skilled, but trying to integrate that knowledge base into an institutional framework for how you as you mentioned, how they assess risk and things like that. So trying to build it, because the knowledge and the risk understanding does exist. It's just trying to incorporate that into a form in which traditional investors will understand. And then, of course, there's also, there's a bit of a perceived uncertainty around revenue streams, because as we've got Yogita on the call, some investors like long-term track records so they can look at a graph and see where things land. So there's a lot of time discussing, trying to educate where these markets have operated for decades in other places. Say it's a carbon market, and there's some compliance markets around the world. So there's a lot of that sort of education piece, and then also where there are other solutions like what we're doing with the UK Nature Impact Fund, is that we've created a public-private blended finance fund. So the UK government's Department for Environment, Food and Rural Affairs has seed funded. They've provided millions of pounds that will go into the fund to provide that market signal to private capital that this is a space they want to focus on, and it also helps through some mechanisms de-risk the private capital, and on the basis that we will crowd in more private capital to work with this public money, but really scale it up and make it go further. And that's some of the areas that we are looking at in overcoming these barriers and trying to move things along with the finance sector.
Thank you. Yeah, that's really helpful. So I think, both of you have talked a lot about different stakeholders, and from my experience, bringing stakeholders together oftentimes really involves highlighting the benefits that preservation of nature and nature-based solutions can bring, and these can be quite different to different stakeholder groups. So Dr. Jeffrey, I wanted to follow up with a question with you specifically on forests. So we all know about the climate sequestration, the climate benefits of forest protection, but what other environmental or even socioeconomic benefits do you come across, and and how does this inform how you interact with different stakeholders? I think you're muted. Did the question make sense? Dr. Jeffrey? Can you hear as well?
Okay, thank you, Laura.
Okay.
From an environmental perspective, the nature-based solution offer a range of advantages that contribute to the ecosystem health, biodiversity conservation, and also the natural resource management. One of the key benefits is the restoration and enhancement of the ecosystem services. So these services, such as the water purification, soil fertility, and pollination, are essential for supporting human well-being and maintaining healthy ecosystems. So by implementing the nature-based solution like reforestation, wetland restoration, and sustainable land management practices, we can enhance these ecosystem services, leading to improved water quality, increase the soil productivity, and enhance the biodiversity. So nature-based solution plays a crucial role in climate adaptation and resilience. Natural ecosystems such as the mangroves, forests, and wetlands act as buffer against natural disasters like floods, storms, and also erosion. So they provide the natural infrastructure that absorbs and dissipates the impact of extreme weather events, reducing the vulnerability of communities and also the infrastructure. So investing in nature-based solution not only helps mitigate climate change, but also strengthen the resilience to its impacts, enhancing the overall climate adaptation strategies. So in addition to the environmental benefits, MBS also offers significant socio-economic advantages. One of the key benefits is the creation of green jobs and economic opportunities. MBS projects such as the sustainable agriculture, ecotourism, and green infrastructure development generate employment and income opportunities for local communities. So this not only contributes to poverty alleviation, but also promotes inclusive and also sustainable economic growth. Another socio-economic benefit of the nature-based solution is the promotion of social equity and community empowerment. Nature-based solution projects often involve local communities in decision-making, planning, and implementation processes. So by engaging communities as partners in conservation and restoration efforts, MBS empower marginalized groups, strengthen the social cohesion, and foster a sense of ownership and stewardship over natural resources. Thank you.
Thank you very much. That's really comprehensive and yes, always fascinating, I think, to just highlight the really multiple benefits, right, that investment into nature has. I'm mindful of time and want to make sure we have time for a closing round of questions. But before that, so just really deep diving on the role of financial institutions, Jorgita, from your experience, how can financial institutions, really drilling down more into the detail, how can they really incorporate their assessment of nature risks and decision making, really, and if you could share maybe even some of the specific metrics used, or touch on TNFD as one of the frameworks that we really have a lot of hope for facilitating this in the future.
Sure, thanks, Laura. I guess thanks, Dr. Jeffrey, for mentioning some of the important aspects of the value of the nature that that is crucial, and I think I want to start there because I think for the investors to properly integrate nature risks into financial decision making, the investors, it's important to understand what are the systemic risks and what are the, I guess, stewardship opportunities that are available, or also like to adopt site-specific approaches, and then based on those to develop those transition plans of integration. So and it all boils down to probably a couple of things. And a little bit oversimplifying here, but essentially it's important to have this asset level data and understanding the kind of specifics of the location and the fragility of the nature. So and essentially nature related risks are often can be categorized as physical risks or such risks bring a lot of complexity and can be difficult to predict. Therefore, I think for a lot of investors, the main challenge is to basically to understand and determine those risks so that they can bring back them to the portfolio. And I think such frameworks as TNFD with their LEAP approach sort of provide this initial guidance how the financial community can approach assessments of priorities and risks in a sense. And in terms of talking about some of the tools available and data, I guess a first step could be something that we've seen in our practices, the screening or footprinting in terms of understanding and measuring portfolios' negative impact on the nature. And basically, I guess to simplify, investors can start assessing their potential financing impacts by identifying companies or activities that could be considered key drivers for biodiversity loss. And I think some of the examples that we heard mentioning before, the palm oil companies and others, you know, those identifying those type of activities or the companies that might have the biggest impact on the nature. And in terms of talking about, I guess, different tools and metrics available, we have like fraction of disappearing species and mass abundance of species, but they all measure different things, and sometimes it's difficult to derive meaningful assessments from using different tools available. So I guess although such models can differ significantly, they can be a starting point for the investors to start their journeys. And I guess perhaps we are at the stage where we have a lot of sort of data available. What we're using, we are relying heavily on artificial intelligence to make certain insights and use those as a proxies for assessments. But hopefully that's a starting point, and we can move that with that ahead.
I'm happy about the optimism. Time has flown by, and we're really almost out of time. So I want to ask all of the speakers again to reflect on maybe the one single biggest action that could help unlock finance for nature-based solutions. And I will, yes. Sorry, Satya, I'm going to put you on the spot first. Didn't have much time to think, but yes.
No, that's all right. I think what we need is we need to build virtuous partnerships that we talked about. I was just last week, I was in Singapore meeting almost everybody who mattered, including Piyush Gupta, the CEO of DBS Bank, the Economic Development Board, and a lot of other companies. And where we're trying to build a World Climate and Nature Guarantee Facility. We've signed a partnership agreement with Federated Hermes. I signed that with Saket Nusibe, their CEO. We launched it together at COP28 on the 2nd of December, with the First Minister of Scotland being there, promising all help. We now have a law firm, McDermott, Will & Emery, who's providing us pro bono support to help develop the structures. And our ambition is to, in the next 15 years, to produce $100 billion in counter guarantees, first loss guarantees, concessional capital, to be able to orchestrate $1 trillion flowing into nature-based solutions. And I was quite impressed, honestly, with the insights shared by Datuk Jeffrey. So I'm going to reach out to you, Pa, to see how we can collaborate, because every country needs this help, and especially countries of the global south. who have the natural resources, but not the economic resources to make the natural resources deliver in a sustainable way that is climate resilient and adaptation and mitigation positive, So that's what we're going to do, and that's the idea. And you need to find blended finance at scale to drive resources into areas where it really matters.
Fantastic. And we see the virtuous partnerships already taking off during this webinar, which is great. Maybe on that note, Datuk Jeffrey, would you like to give us your one action? Yes, short and concise, please. Sorry, because of time.
Okay, thank you, Laura. So I would like to echo the viewpoints of Satya just now. That thank you for your wonderful comments by my statement. So by collaborating across actors, sectors, and also disciplines, we can pool resources, share expertise, and co-create innovative solutions that address complex environmental challenges effectively. So furthermore, collaboration helps in managing uncertainty and risk by leveraging collective intelligence, diversifying the funding sources, and also building resilience to environmental shock and disruptions. So with that word, thank you so much, Laura, and all the panelists. Thank you so much.
Thank you. Andy, over to you. What's the single biggest action from your point of view?
Yes, so building on Satya and Dr. Jeffrey, I think it's slightly different, but I would say and encourage those with the capital, those investors to get out there into the field, on the ground, in the places and communities where these nature-based solutions will be delivered. And I think, this is the best way to grow understanding, appreciation, feel a connection to the project, to the people, their investments, the stakeholders, and the real impacts that these can deliver on the ground. So yeah, get away from the desks and the computers and get out there into the nature to really build that connection. And that should, bring everyone closer together and see help galvanize that action as well, in my view. Yeah.
I think that's a really good one. Yeah. And Yogita, over to you for the final single biggest action.
I guess I can only echo to what my fellow panelists said. I think the partnership is a good way of approaching the problematics of this complex topic, but also getting on the ground is something that we all should do. And perhaps the last thing I want to highlight, the importance of technology that could perhaps help to also connect all of us and also to address some of those still gaps that are related to biodiversity related assessments.
Yeah, we didn't have a chance to deep dive on technology, but absolutely agree. There's so much potential, machine learning, AI, that could make this, especially the data challenges, a lot easier to process. Thank you so very much for all your contributions. Maybe just to take one final minute to summarize what I took away and heard and learned today. Which is, I think, very much the starting point. Nature will not keep giving. I think, Satya, that was a really important point to start on. I also took away that from all of your fantastic examples, financial returns and nature positive outcomes are certainly not impossible to combine. And we've heard some fantastic examples of your different organizations doing that every day. I've also heard some hopeful news around the development of frameworks, positive developments in the data space, and especially tools becoming increasingly available. We heard about TNFD and footprinting. Of course, we know there are a lot of challenges ahead, but I think I want to take away on a hopeful note that this should not keep every single organization from using these frameworks as a starting point already today, and don't let the perfect stand in the way of the good. Yes, and lastly, really to embrace partnerships. I think that was a key theme. We're all not alone. There are so many organizations out to partner up with and share knowledge and build capacity together. So On that note, yeah, thank you again, and all the best. Thank you for your attention.
Thank you.
Thank you.
Thanks, everyone. Have a great day.
That was a fascinating discussion between Laura, Satya, Andy, Dato' Jeffrey, and Jurgita. I eagerly await the moment when trillions of dollars will be invested in nature-based solutions. We will have 2 deep dive fireside chats on Islamic finance. By promoting ethical and sustainable investments, Islamic finance can play a crucial role in scaling up sustainable finance in ASEAN and beyond. Up first, Omar Sheikh, Managing Director at our Ethical Finance ASEAN partner Jeffy, will lead a discussion with PwC Middle East and Jupiter Asset Management on the opportunity to move from a halal to Tayyib-inspired approach to Sharia-compliant investing. The virtual floor is yours, Omar.
Okay, well, welcome back, ladies and gentlemen. We're at this excellent fireside now on Islamic finance and moving from halal to Tayyib, accelerating Islamic sustainable finance. It's a real honor and pleasure to be joined by 2 experts with us for this panel. We have Shireen Osman, a director from PwC Dubai with us, who leads a lot of the firm's work on Islamic finance with auditing the various Islamic financial institutions there. And we have Salman Siddiqui, asset manager at Jupiter Asset Management, joining us from London. So thank you to both of you for giving us your time to join this session. Islamic finance, as many of us know, is a faith-based form of finance, would expect us to have it very much aligned with ethical and sustainable principles. What I'm hoping to understand from both of you during the course of this fireside chat is actually how far is Islamic finance embracing sustainability? What's working, what's not working, and where do we see the opportunity for Islamic finance to advance that? So to kick off, I'd love to ask Shireen, ask you the question. The title of this session is Halal, moving from halal to Tayyib. Please, first of all, can you just explain to us and everyone watching, what is the significance of the concept of Tayyib in Islamic finance, and how does it differ from the understanding of halal? I'm conscious at COP28, together with the UKFC and indeed us at Jeffy, you launched the Tayyib-inspired secretariat. So please do explain this to us first.
Sure. Thanks so much for the introduction, and quite happy to be here today. So the Tayyib concept basically moves Islamic finance from being a pure compliance from a halal paradigm to one that now considers and focuses on the spirit and purpose of Sharia, that being the maqasid. If you simply look at the meaning of Tayyib, it refers to something which is pure, clean, or wholesome. And what that means for the Islamic finance ESG market is transcending it from the tick box of just halal to looking at whether products holistically are evaluated against its contribution to society. As you said, yes, we were quite proud to be part of the launch of Project Tayyib with yourselves at Jeffy and UKIFC. The Tayyib framework aims to be a practical tool for the Islamic finance instrument issuers, and that will align the maqasid within the ESG framework. Us at PwC, we are proud to be the exclusive technical partner to the Secretariat, and our role will be to support in the development and implementation of the framework, as well as then to provide issuers who aspire to obtain the certification, the assistance in the form of gap analysis or roadmaps.
Great, thanks, Shireen. So you're saying you've taken the concept of Tayyib and Tayyib inspired to integrate ESG and sustainability principles into the current practice of Islamic finance, which is principally been negative screening within Islamic asset management specifically.
Yes, exactly that.
Right. So then Salman, if I can bring you in on this. So we're saying the Islamic asset management world has been negative screening to date. Of course, it also has some financial ratios as well, which are applied through its leverage screens. But can you tell us a bit more about, within the Islamic faith and Islamic asset management, the role and understanding of concepts of stewardship and sustainability, and how is current Islamic finance Sharia compliant investing fulfilling these duties?
Yeah, sure, absolutely. Thank you. Look, I think that you're right. Stewardship and sustainability are very much embedded in our faith. As Shireen said, in terms of the spirit of Sharia, the Prophet Muhammad, peace be upon him, said the earth is green and beautiful, and God has appointed you his stewards over it. Whoever plants a tree and diligently looks after it until it matures and bears fruit is rewarded, etc. And there's lots of examples of that. And it was really interesting for me as a fund manager, because I've been managing conventional funds for around 20 years. And just 2 years ago, I had the chance to take on a Sharia mandate. And it was interesting because a few months prior to taking on this mandate, my team and I had just completed a big ESG engagement with a Chinese sportswear company, where we had been becoming increasingly concerned around the risk of forced labor in the company's cotton supply chain. As many people will know, most of the cotton in China comes from Xinjiang region, where there have been numerous concerns around the possible use of forced labor. And so we were very keen to ensure that at least this company that we were talking to, its supply chain was clean. And we spent a long time trying to understand their workplace, their labor practices, the practice of their suppliers, all the way down to that cotton field. There was much back and forth. In the end, we were not able to get the assurances that we felt we needed, and we ended up divesting from that company. And that's quite a rare thing, to divest from a company. Obviously, what we like to do is to be a force for good, to encourage and engage. But in this instance, we felt that wasn't an option. Now, it was interesting for me because fast forward a few months when I took on the Sharia mandate and I looked down the list of companies included in the Sharia index, then one company popped out, jumped out at me. And of course, it was that same Chinese sportswear company. And it really got me thinking, surely God would also want us to consider labor rights. And of course, he does. The Prophet Muhammad, peace be upon him, said, your workers are like your brothers, pay your workers before their sweat has dried up, etc., etc. And of course, as Shireen said, the reason why this company made it through is because on that negative screening, of course, sportswear is fine, right? It's not tobacco, it's not alcohol, it's not interest-based finance, gambling, etc. It's not one of those traditional sin stocks. In other words, we are focusing purely on what a company produces and not how those products or services are produced, and in doing so, perhaps missing some of that spirit, as Shireen mentioned. And so I guess for me, certainly when I took on this mandate, and I said this to the client, I said, look, I'm the fund manager, but I'm also the target customer of a product like this, and I wouldn't buy it because I feel that it doesn't really align with my values. And I felt we had a really unique opportunity to try and create a product that went beyond just negative screening. Yes, fine, it has that Sharia compliance, but also goes beyond that to true active ESG engagement as well.
Great. So Jupiter's got a great pedigree in sustainable finance and ESG investing there. And I guess then the question to me is, and Shireen, I'll come to you on this. We have Sharia compliance, we have ESG as is practiced in conventional mainstream. We've mentioned now Tayyib, you've mentioned the word Maqasid, and we have, we're now beginning to see Islamic sustainable finance, particularly in the UAE, where the central bank has issued guidelines on this just ahead of COP. Irrespective of terminology, to what extent are you seeing Islamic financial jurisdictions embracing sustainability? Apologies, that's a fire alarm, but please do continue.
Yes, Umar. So I think what we witnessed last year during COP28, being the year of sustainability, was a clear call to action from all nations. And so the progression from there is that the industry is basically going through an evolution in trying to meet those targets and the promises that were made. COP28, I feel the fact that it was hosted in Dubai itself, in the UAE, sorry, was a catalyst and was a sort of a push for the Islamic finance industry, because it needed that exposure and for people to realize the link between the two. And I feel what we've seen since then is that Islamic financial institutions globally have started to become a lot more active with this drive from COP28. I read recently an S&P which estimates that global sukuk issuance for 2024 is likely to be somewhere between 160 and 170 billion dollars. And I believe that a fair chunk of that is going to come from sustainable sukuk. If we look at the ASEAN region, and if you see the key issuers in that region, you're looking at Indonesia and Malaysia. Indonesia has been quite active in the space for quite some time. I think the fact that it's got its Muslim majority population, it's susceptible to climate-related disasters, and then its own socioeconomic issues, it aligns itself quite well within that ESG Islamic finance agenda. And so we'll continue to see a number of issuances come out from Indonesia. Malaysia recently announced a number of tax incentives to promote its targets and combat social issues. So there as well, we'll continue to see a lot of activity come through. If I come closer to the Middle East, the core Islamic finance countries' financing requirements will continue to be strong, particularly from Saudi Arabia with its Vision 2030 initiatives, diversification away from oil. And then in the UAE, I think, like I said, with COP28, we've seen quite a bit of activity come out from the UAE itself. There's and it's not just from Islamic finance institutions, there's also the non-Islamic finance institutions that have had some activity. I'll give a couple of examples like DEWA and Mazda's solar park. That went through another round of funding. The China Construction Green Bond, the Dubai Islamic Bank, which launched a sustainability links to Sukuk, the third of its kind. And then also governments. So we've had the government of Sharjah, which issued their sustainable bond. So there is definitely quite a lot of momentum.
So you're seeing a strong market case, a strong demand. And Salman, are you seeing the same as well? What from your lens, how are investors in the kind of ASEAN region, how are they engaging with ESG? Are they more or less engaged than what you're seeing in Europe? And if so, what can be done to increase the momentum in terms of growing assets in Sharia compliant funds, which are sustainable as well?
Yeah, sure. I think that it kind of varies from country to country. I mean, certainly Malaysia is a real pioneer, of course, in this Tayyib space. But it's interesting because I think investors in Asia and Middle East are often perceived as being lagging behind the West in terms of ESG considerations. But actually, there was a study done by Schroders and Maybank not too long ago, which actually showed that sustainability and climate change could be a greater consideration in Asia and Middle Eastern investors than in other parts of the world, which I thought was quite interesting. But if we take a step back and look at kind of Sharia AUM as a whole versus the ESG space, I mean, we can see that whilst Sharia AUM has grown, it has grown much slower than the traditional ESG space. And there's kind of an enormous order of magnitude difference in terms of size. And, you know, we believe that if Muslims were able to better incorporate their Islamic values into their investment decision-making, so it's not just that kind of tick box, then I think we could start to see greater momentum in terms of the growth of assets. I mean, we obviously mentioned COP earlier. I was at COP as well. And I think for me, one of the key takeaways was that there is a real drive and a real desire to move away from simple negative screening. And I think definitely anyone under the age of 35, you know, when they hear negative screening, their eyes just kind of glaze over. You know, they're just not interested. What they want to see is something much more meaningful, much more impactful. And that's why I think this conversation is so important.
Great. Well, look, thank you so much, Salman. Shireen, I'm conscious we have just run out of time there. So I just want to say a huge thank you once again to both of you for sharing this. Very much looking forward to see how Islamic sustainable finance as a market space, as a thematic builds out. At the UK IFC, UK Islamic Finance Council, from the work they've been doing with the Global Islamic Finance and UN SDGs Task Force and the high-level working group on green and sustainable Sukuk. As you mentioned, Shireen, last year that market crossed 10 billion of issuances, which represents nearly 6% of all Sukuk issuances. So absolutely an exciting space, considerable market opportunities. but also, as you said, Saman, the right thing to do, which people, fundamentally consumers at all levels, want to see their values and their faith aligned in that progressive manner, above and beyond the negative screening, the do no harm. Fantastic insights. Thank you once again to all of you, and I'll hand back to the MC. Thanks. Bye-bye.
One thing I picked from the session is that Islamic financial institutions are paying more attention to sustainability. I look forward to seeing how the Tayyib Secretariat supports the alignment of sustainable investing and Islamic finance to create a more sustainable, inclusive, and equitable world. Stella Cox, CBE, the Managing Director of DDCAP Group, will now lead a discussion on the role of green sukuk for climate action. I'm looking forward to hearing about the recently launched International Capital Market Association's practitioner guidelines on green and sustainable sukuk. Stella and colleagues from the London Stock Exchange Group and HSBC Amana, welcome to Ethical Finance ASEAN 2024.
Thank you, Shireen. Welcome to this fireside session on green sukuk for climate action. Data shows that global sustainable bond issuance, in which I include green, social, sustainability linked instruments and sustainability, totaled more than $1 trillion in 2023, bolstered by record levels of green bond sales. Issuance of impact bonds totaled almost 940 billion last year as well. And although this didn't quite match up to record issuance highs of 2021, when it reached $1.1 trillion, green bond sales from corporates and governments did, rising to $575 billion. Social bond sales in 2023 stood at 135 billion, some way below the record of $220 billion issued in 2021, which was a response to the pandemic. Issuance of sustainability bonds also fell back to about 160 billion last year. So sustainability-linked bonds actually saw the largest decrease in issuance volumes in 2023. At $68 billion, the total was some 22% lower than 2022. And that's likely explained by ongoing concerns regarding some credibility around target setting. However, ESG-aligned investors are seemingly supporting the understanding that this world is not going to deliver against a 1.5-degree warming situation if financing is limited solely to green assets, because there simply isn't sufficient supply. Since being introduced at COP26, the conversation related to transition financing has shifted positively compared to 3 years ago. And this year we've seen already that Japan has issued $11 billion equivalent of sovereign climate transition bonds, with proceeds being deployed to fund the nation's green transformation program, and all indications that there's a significant expansion plan during the next decade. So having set the global context for sustainable bond markets, I'm sure you're all as enthusiastic as me to bring this discussion around to focus on developments both globally and regionally for green sukuk and other Sharia-compliant instruments that are going to help catalyse the sustainable Islamic market. In that regard, it's my honour and my privilege to introduce our contributors, our speakers to this fireside session. Shrey Kohli is Head of Debt Capital Markets and Product Origination at London Stock Exchange Group and a member of the Primary Markets Senior Leadership Team. He also sits on LSEG's Group Sustainability and Fixed Income Management Committees. Shrey chairs the high-level working group on green sukuk established at COP26 and was previously a member of the Advisory Council to the ICMA Green and Social Bond Principles. Raja Amir Shah Raja Azra is CEO of HSBC Amana, and since his appointment in 2021, he's been responsible for executing HSBC Group's strategy in Islamic banking in Malaysia, driving sustainable leadership and value-based intermediation efforts. Raja Amir has made many significant contributions to the development of both international and Malaysian sukuk markets, having originated, structured and executed multiple landmark sukuk firsts for corporate, financial and public sector institutions across Asia. Shrey, to set the scene and as chair of the high-level working group on green sukuk, could you provide an overview as to the current size and scale of the green sukuk market?
Thank you, Stella, and delighted to be here. So Stella and Raja Amir, you've been members of the high-level working group as well. You'd remember when we set this up at COP26, the ambition was to get to a market that was issuing nearly $30 billion annually. From a starting point of about $5 billion in 2019 and 2020. And I would say we're halfway there. So in 2023, we saw $13.4 billion of green, social, and sustainability sukuk issued in the market, which is nearly a 3 times increase from where we were when we set this up at COP26. ASEAN makes a majority of the share of the sustainable sukuk which has been issued so far, nearly 50% between Indonesia and Malaysia. But with the Middle East catching up very quickly with significant issuance from the UAE as well as from Saudi Arabia, there's nearly been now $47 billion of sustainable sukuk been issued, which in context of the amount of sustainable bonds been issued, it pales in number based on the stats that you gave, Stella. However, as a percentage of the sukuk market is getting to a similar envelope in terms of the percentage of sustainable bonds to the conventional bond market, so nearing 8 to 10%. And so we see a pretty big potential for growth over here to get to that $30 billion number, and the market is showing signs of strength in 2024 with an incredibly strong Q1 with over $4 billion being issued.
Thank you, Shrey. Raja Amir, from what Shrey said and also from the data that we can see, this market is clearly growing. From your perspective as a banker, what do you think is driving the demand? And that's both within Malaysia and beyond it.
Thank you, Stella, and pleased to be here. There's a number of reasons why we see an increased demand, both from fixed income investors as well as financial institution customers. And I would break this down into 3 main topics. So the first one being an emphasis on sustainability and stakeholder awareness. So we need to be clear that there's a lot of pressure as well as a lot of encouragement, which is being put on issuers as well as corporates to adhere to the ever-evolving nature of climate change. So there's an urgency regarding climate change. Companies are becoming more aware of this. And by accessing the international as well as the domestic capital markets, they are able to put out their ambitions as well as raise financing to meet the significant amount of financing which is needed. In addition to that, the good work which is being done today with this document also is that collaboration that we see happening in the international market with ICMA and various other parties, which is also stimulating the market in terms of providing a very clear and document which allows issuers who have not issued in this market to be able to consider as well as assess this market. And then finally, in terms of the awareness portion, is that investors are asking for it. Investors are getting clearly more in touch with their needs to subscribe for sustainable issuances, and in turn that is driving fund managers as well to structure and to subscribe for these products. One more thing is also the respective listing requirements, which is also pushing investors as well because of the various respective jurisdictions. There are also listing requirements which who makes it onto certain indices and so on. So there's more disclosure which is being done by issuers, and again, by assessing the capital markets allows them that framework to be able to further disclose and publicize what they're doing. I would also say, Stella, in terms of the regulatory support as well as intervention by regulators, as well as certain cross-border incentives, are really pushing the market. So we see a lot of regulators within various jurisdictions coming up with frameworks, incentivizing issuers to assess the green markets. There's all sorts of grants as well as incentives which are being offered. So this is really pushing the market to issue. Now, there's also cross-border financing situations such as the cross-border adjustment mechanism, the CBAM, which is putting onto the plate certain costs which need to be incurred by issuers. So therefore, there's also an adherence to that. And therefore, by raising sustainable financing, that allows them to not only project their sustainable credentials, but also seek financing for some of these projects. And then finally, within the context of investment appetite and market awareness, I mean, this is something which is probably proves to the numbers that we talked about, There is a growing demand for both institutional as well as retail investors for ethical and sustainable investment opportunities, which is aligning with their own personal needs as well as their quest to obtain returns. So we can also see that there's also some of these Sukuk issuances are long-term in nature, so it provides that stable fixed income returns. We've seen, Indonesia and Malaysia raising their sustainable issuances in the context of 10 years. So that gives that continual fixed income flow for investors who are seeking those returns.
Thank you very much. Shrey, Raja Amir refers to raising awareness and to collaborative efforts as well. And in that regard, I know that you were involved in the recently published practitioners' guidance that the International Capital Market Association produced in collaboration with the Islamic Development Bank and the London Stock Exchange Group. And that was intended actually for the benefit of market participants. Could you tell us a little bit more about that?
Yeah, absolutely. So I think the problem that we identified in the course of working together at the high-level working group is that the issuance of a sustainable sukuk brings nearly two distinct challenges. First is structuring the sukuk itself and communicating to investors both domestically as well as internationally to help them understand the structure of the sukuk. And for a number of investors internationally who may not be Islamic finance investors, there's an element of demystifying that you need to do about sukuk as an asset class itself. Despite there being pretty strong alignment between Sharia principles of investing and ESG principles of investing. And the second challenge is for credibility within the global market for sustainable financing within fixed income markets, the ICMA green bond principle, sustainability bond guidelines, as well as the sustainability linked bond principles are now the de facto standards that you use in the market. And there is a process that you go by setting up a sustainable framework to identify, at least for user proceeds bonds, where the money is going to, which projects it goes to. So both those two challenges create a hurdle or a little bit of friction in terms of issuing in the market. So the guidance, as you said, Stella, is a practical guidance which is out there, which is aimed to help issuers step through the process of issuing a sustainable sukuk. And the guidance found a few things. We launched it in Riyadh last week with the Islamic Development Bank at the Golden Jubilee meetings of the ISDB. And what it found was widespread prevalence of the ICMA principles across multiple jurisdictions, so to prevent any fragmentation of standards, a large applicability of the use of proceeds and target populations, and very importantly, that some of the themes that ICMA has identified, blue finance, transition finance, and gender-based finance, which are critically important, I think, for the ASEAN region, extend very easily to sukuk as an asset class as well, as long as you identify the use of proceeds. So the guidance is out there in the market, and the work now is really for us to work with domestic regulators, Sharia boards, rating agencies to point to the guidance so that it becomes effectively a way to clear that friction and transform that market from $13 or $14 billion to the 30 billion mark that I was talking about earlier.
Thank you. There's no doubt that we're amidst a period of very positive momentum within the sector. Raja Amir, I'm guessing that in your capacity of CEO at HSBC Oman, you do subscribe to the view that Green Sukuk can and will unlock capital at scale to facilitate or help facilitate the transition to a more sustainable economy. I'd be interested to know how you think that the recently published guidance will help to catalyze the market as well.
Yeah, thanks. From my perspective, the guidance document will be helpful for potential issuers who are looking to assess the market, because what it does is really it breaks down the nuances between a Sharia-compliant financing as well as the various potential structures under green, social, sustainable. We've talked about the blue as well as gender sukuks that can be issued. So what it does is really mainstreams, I would say, in terms of the kind of issuances which are happening already in the market. And for those issuers who have already issued in the conventional space, and who are considering issuing within the Islamic finance space and really tapping on that liquidity, which is extremely strong in the market. This document serves as a best practice document, which lays out very clearly in terms of the nuances, as well as providing very clear best practice principles, in addition to also giving a whole slew of case studies, which allows the reader to understand what has already accessed the market and provides that sort of framework for them to be able to consider. Secondly, I would say this guidance allows issuers to consider innovation in the green sukuk market. It provides clarity. It shows what has been done before and what can be considered. So I would say that with such documents being very encouraged in the market, because it allows issuers that kind of comfort that this is a mainstream product and it's not something on the periphery.
Thank you. Well, we find ourselves already in May. I can't believe that 2024 is moving so quickly, but I'd like to open this to both of you, perhaps starting with you, Shrey. Keeping within the context of Green Sukuk and in no more than 60 seconds, please. What would you like to see achieved by the end of this year?
We could spend a lot of time on it, Stella. I mean, I point at two things. So one, as Raja Amir said, now that the practical guidance, which has been really driven by ICMA, ISDB, and LSEG has been set up, we would like multiple jurisdictions to start pointing to that in the ways that they can do. So through local Sharia boards, which are pointing towards the document, through regulators, which are pointing to it as a helpful resource, which is available. Because what we don't want is the document to be put on a dusty shelf. What we do want is for it to be a living guide. Which is what we'd encourage you all at this conference to do as well, to read the document and see how it can be useful within your conversations. And second is just purely on numbers. So, I'm hoping and expecting that we go past the $15 billion number this year. I don't think 20 billion is unachievable, but to be on that road to 30 billion and to achieve that sooner and rather than later is what we're trying to catalyze the market. So those are my two hopes for this year.
Thank you. Raja Amir, your aspirations for achievements by the end of 2024, please.
Yep. I'd like to see, as Shrey mentioned, an increased number of issuances in the market to further, catalyze the market further. Within that, I would hope to see a bit more diversification within the sectoral place. So, companies within the hard to abate sectors also looking to this market as a means to transition to a low carbon economy. So I'd like to see increased issuance, diversity of issuers, as well as the diversification of projects. When I say diversification of projects, I'd like to see capital markets being used to finance projects, beyond what we've seen already, which within the space. So, moving on to green transportation, renewable energies, we've seen waste management, sustainable agriculture, perhaps maybe even hydro energy, as well as waste to energy. So I'd like to see a diversification in issuers as well as projects. I'd like to see the continued global collaboration as we are doing today with ICMA, LSEG, and many partners on this project. I think it's integral for the industry to come together to be able to come to a landing on the various solutions on the table to be able to scale, as you mentioned, Stella, the kind of financings available in the market. And finally, I'd like to see innovations within the space as well. So we've talked about different issuers, different projects, further going down the curve in terms of nature-based solutions, multilaterals participating in this financing to remove the risk from the typical capital market investors. I'd like to see various transactional structures being embedded to cater for the various stages of the financing for these projects. And finally, I'd like to see a diversification in the type of issuances. So perhaps a Waqaf Sukuk could and hopefully will come to fruition in the near future, because this is a different asset class. The investors are looking at different forms of returns. And it is something which is very specific to Islamic finance. So I hope we can do that, and scale that further.
Thank you very much. Well, I certainly wish that we had longer, but we don't. We've reached our time. I'd certainly recommend to everybody who hasn't that you do take a look at the guidance that was recently published, because it takes a different look at bringing awareness to market practitioners. But Raja, Amir and Shrey, it just remains for me to thank you both for a very interesting and enlightening conversation. And it's been a pleasure to to be part of that with you at Ethical Finance ASEAN 2024. Thank you very much. Shireen, handing back to you.
Thank you so much, Stella, Shrey, and Raja Amir. I know Jeffy's sister entity, the UK IFC, as Secretariat to the High-Level Working Group on Green Sukuk, has played a key role in promoting Green Sukuk, and it sounds as though Green Sukuk can definitely play a key role in scaling up sustainable finance. To draw Ethical Finance ASEAN to a close, I would now like to invite Dr. Zameh Iqbal, Vice President, Finance and Chief Financial Officer at the Islamic Development Bank, to deliver our closing keynote.
Distinguished guests, panelists, ladies and gentlemen, very good morning, afternoon, or evening to you all joining us virtually. Let me first begin by thanking the organizers for inviting us and for all their efforts towards putting together this year's Ethical Finance ASEAN Summit. The theme of the summit, Scaling Sustainable Finance in ASEAN, is very timely and relevant as more finance needs to be mobilized for more greener and sustainable interventions. A massive funding gap still remains for the Sustainable Development Goals. Billions and trillions are quoted on a regular basis. We should not lose this opportunity to drive more financial resources towards sustainable development that is direly needed to prepare better for the future. The criticality of this cannot be overstated. If we are to plug this huge financing gap for the SDGs, including for the ASEAN countries, we need to ramp up efforts to strengthen alignment of the financial and capital markets with universal values such as environmental stewardship, social responsibility, integrity, collaboration, and building resilience. This will require all hands on the deck and all capital at productive use. At our end, I can assure you that Islamic Development Bank is fully committed to promoting and further scaling up sustainable finance. ISDB, the realigned strategy, has several key pillars, one of which is driving green economic growth. This includes the transition to low-carbon economies by prioritizing energy investments towards renewable sources. This is envisions to help countries progress towards their net zero targets. Having this pillar embedded in our strategy was a critical factor to proactively align our own financing with increasing ambitious climate action. As a result, I am pleased to share that we achieved and surpassed our 35% climate finance target ahead of time last year, whereby 46% of our annual approvals were geared towards climate action, including adaptation and mitigation activities. On the social side, the latest example of Islamic Development Bank's commitment is its approval of $846 million in financing for the Republic of Indonesia to strengthen the country's healthcare referral network. The project aims to improve the physical and service capacity of the health referral system in Indonesia, ensuring equal access to quality healthcare services. It will also reduce the burden of non-communicable diseases as well as mother and child health. The scope of the project encompasses medical equipment provisions of 535 district hospitals, 47 province hospitals, and 23 health ministry hospitals. Without a doubt, the demand for both green and social finance is massive, and ISDB is answering the call on both fronts to help the progress towards the SDGs. In terms of promotion of sustainable finance, as you have already heard earlier today, Islamic Development Bank joined hands with the International Capital Markets Association, ICMA, and the London Stock Exchange Group to develop the guidelines on green, social, and sustainability sukuk. From the Islamic Development Bank's perspective, the sukuk market holds critical importance, especially green and sustainability sukuk issuances to mobilize higher SDG financing, including for climate finance. We have mobilized more than $5 billion to date from both green and sustainability sukuk issuances, and supported by strong pipeline, we will continue to work to unlock more sustainable finance from around the world. It is in this context that the guidelines were developed to further enhance awareness of this asset class by collecting feedback from multiple stakeholders from various segments of the capital markets. The guidance was launched last week at the 2024 annual meeting of Islamic Development Bank in Riyadh, which happened to be our 50th anniversary. And we have already received a lot of positive feedback regarding the alignment as demonstrated in the guidance and the potential for utilizing sukuk to finance sustainable development. On a similar note, I was pleased to learn that ASEAN region has also taken important strides to develop specific taxonomies and standards for green, social, and sustainability bonds and transition finance, among others, to expand this segment in the region. These are significant building blocks that I'm sure will help to mainstream and scale up sustainable finance. As a South-to-South organization, we at the Islamic Development Bank believe such successful initiatives need to be replicated in other regions as well. And we would be very happy to facilitate and forge partnerships to this end. It is through collaboration and cooperation that we will succeed in the further scaling this and driving finance to where it is most needed. With these thoughts, I thank the organizers once again for their sincere efforts and for the kind invitation. Let us keep working together and build stronger partnerships for a better future. I thank you for your attention. Thank you so much.
Many thanks, Dr. Zame. That was a fitting conclusion to an interesting and engaging day. Thank you to all of our expert speakers for taking the time to participate today. And thanks also to you, our virtual delegates who have joined from the ASEAN region and beyond. The summit aimed to raise awareness and inspire action, and I hope we achieved that objective today. It certainly has given me lots to think about in my role at the AICB. I'm also grateful to my colleagues at AICB, Jeffy, UNEP EPFI, and all of our supporting partners who have worked hard to make today happen. It has been a great pleasure being here with you. Wherever you are in the world, have a wonderful day, and thank you for joining us today.